9 a.m. here in New York City. I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief.
Good morning, everyone. Stock futures, they are sinking this morning. The global sell-off intensifies here as the Dow futures are plunging more than 1,000 points, more than 1,200 points right now, and the Nasdaq is set for its biggest opening drop in more than 4 years here. So let's get to it with the three things that you need to know to start your trading day. Yahoo Finance's Jared Blickry, Brian Sazi, and Josh Shaver have more.
That's right. Stock futures are in the red with the Nasdaq leading losses amid a global sell-off. Softer than expected jobs report is exacerbating concerns over the health of the U.S. economy. U.S. recession fears sparking the VIX Volatility Index to hit its highest level in 4 years. Meanwhile, Japan's Nikkei is plunging. You can see it down almost 12% there, marking its worst day since the 1987 Black Monday crash on Wall Street.
Apple and Nvidia are leading the declines on the Nasdaq as the tech sell-off spreads across Wall Street. Shares of market darling Nvidia are being pounded in the pre-market down about 13%. The drawdown of the Nasdaq has sent the tech index into a correction, leaving many investors wondering if it's time to sift through the carnage for buying opportunities.
And crypto isn't safe from the global sell-off either. The price of Bitcoin falling more than 15% this morning. This marks the cryptocurrency's worst price decline since 2021. Exchange platforms like Coinbase are taking a hit too. That stock down more than 16% in pre-market trading. Crypto miners also seeing double-digit losses in the pre-market.
Our top story this morning, the market sell-off. As it stands right now, let's give you a better idea of exactly the type of pressure that we are seeing across the board. You've got the Dow on track to open the day off just over 1,200 points. We've seen this market sell-off, which started overnight over in Asia when we saw the massive drop in the Nikkei. Now that is spreading on a global scale. Taking a look at some of that other pressure that we're seeing in addition to the Dow futures, also the S&P 500 futures, that's on track to open the day off just about 4%. When you take a look at the Nasdaq 100, a lot of the pressure that we're seeing being led by a massive drop in a lot of those tech names. As a result, you've got the Nasdaq 100 actually set to open off just over 5.5%. So that's really telling you just the fact that the Nasdaq taking the brunt of that selling. Now, when you take a look at some of the other action that we're seeing here at the open or ahead of the open, I want to take a look at the semiconductor index and also what we're seeing in some of those larger cap tech names, because that really tells the story of some of that selling pressure that we are seeing very much across the board. You don't have to look any further than the Nasdaq for that. And when you take a look at these smaller numbers that are on your screen right now, those are the pre-market moves. So most of that here in the red. You've got Apple on track to open the day here off just about 9.5%. That's selling also carrying over to the Nvidia. You've got Nvidia off just about 12.5%. There was a report out from the information just about delays in that Blackwell chip. That's really aiding to some of that sell-off that we are seeing, but really it is broad-based selling. You've also got Microsoft set to open today off just about 5%. To Google firmly in the red. So those Mag 7 names that had been carrying the market now for so long really leading the way to the downside. I talk about some of that pressure from Nvidia. I also want to take a look at some of these semi names. You got Taiwan Semiconductor, that name on track to open just off just about 11%. Broadcom also firmly in the red. So again, lots of action that we are seeing there, lots of selling pressure almost across the board. And I mentioned some of the pressure that we're seeing here across the major averages. I also want to take a look at what we are seeing play out in the bond market right now, because you got the 10-year yield here dropping pretty dramatically. We have been off just about 18 basis points there, the worst drop that we had seen in just about 9 months. The U.S. 2-year yield right now below the 10-year yield. That's happening for the first time since July of 2022. So again, pressure across the board as we are seeing traders really up their bets that central banks need to act and need to act quickly. Also briefly wanted to touch on crypto, because that's also, we are seeing some red across the screen when it comes to Bitcoin right now. You've got Bitcoin on track to open off just about 18%, although it trades 24/7 here, so it is falling just about 18%, holding right above that $50,000 level. So again, if we see that fall, hold here, we're looking at the biggest drop that we have seen since November of 2022. So again, selling that we are seeing across the board here, Brad, as we set up to start a new trading week.
Yeah, it certainly seems, of course, coming after last week's activity that we were watching, and then really towards the end of the week, because we had a lot of economic data that came out, and then you had that Fed decision, and then you also had more economic data in that worse than expected jobs report, which kind of triggered for this market the mindset of bad news might start to mean bad news if this Fed is too late to cut. Here's what we're also going to take a look at. The VIX up on your screen, and that's bad news right now. The VIX spiking and hitting a level at this marker, a level that is analogous with the COVID pandemic and the heights of the COVID pandemic. And this is, of course, what the street knows as the fear gauge index. And taking a look at just some of those levels here, the biggest daily jump since February 2018, that was back when we were looking at this at about 50, 55. And so now we're at 63. We'll see exactly where that is compared to. But ultimately, let's also zero in on some of the underperformers falling below some key metrics. And one of the key metrics that I'm tracking here this morning, the 200-day moving average. This, of course, is one of the simplest ways to get a comparison of the average price over a specified period and kind of plotted over time. But ultimately, crossing below this 200-day moving average, you've got names like Amazon, AMD, ASML, Salesforce, and Chevron. What's notable about that is that some of these names that are starting to hit below those 200-day moving averages or crossing into them are some of the most actively traded names on the street, crossing below the 50-day moving average here, a shorter time span. One of the ones that I'm tracking here, or at least several of them, we've got names like Broadcom, Costco, Google, JP Morgan, Microsoft, Netflix, NVIDIA, and Tesla. And here's what's notable about some of those names. For Microsoft and Tesla, at the start of today's trading activity, they may well cross below those 200-day moving averages. That's just how close they were to them. So let's dig further into this sell-off with Yahoo Finance Executive Editor Brian Sazi. Sazi, we've laid out a lot of what we're going to be tracking coming into the opening bell here in the opening cross. Lay out the why from your perspective behind this sell-off.
Yeah, there's a lot of information coming at investors right now. So we're doing our best here at Yahoo Finance to distill it into things that are easily understandable and you can put in context and track throughout the session and what ultimately could be a very volatile week in markets. Really, three reasons stocks are getting pounded here. Number one, perception that the Fed has missed the boat, ... Again, that jobs report, a lot of folks I'm talking on the street right now, that jobs report on Friday really badly missed consensus forecasts. And now there's this view, at least for today, that is, of course, market narratives change literally second by second. There's a concern the Fed should have started cutting rates already if growth is going to slow down. So something to watch there as well. That's the narrative, at least today, amongst a lot of folks I'm talking to in the street. Number two, when Warren Buffett dumps stocks, bears growl. We got that news over the weekend that Warren Buffett continued to sell shares of Apple. Lightning is a load on stocks and more generally. There are really a legion of followers of Warren Buffett's various investing disciplines out there in the world of markets. So when you see Warren Buffett selling stocks at a time where stocks were already off their highs, some people use that as a red flag to go out there and sell some more. And then last but not least here is, where is all that AI chat money in tech earnings? We've seen Microsoft, Alphabet, you name it. I go back to Salesforce a couple weeks ago as well. We're not seeing, I think, a lot of these big cap tech companies justify their valuations based on what they're seeing in all things AI. I was talking to a couple investor relations people at one prominent tech company late last week, and they readily acknowledge, guys, they're not making large sums of money on AI, but is it a different story 10 years from now? Sure, absolutely. But in this market, today at least, investors don't care about what's going to happen 10 years from now.
Yeah, so, Brent, I guess from the sources that you're talking to, how are they thinking about this dip that we're seeing right now? Is it a buying opportunity? Are we expected to see more pressure ahead just given all that uncertainty and some of the trends that you are seeing play out right now in the market? And also just given where we are in the earnings cycle as well.
I still don't get the sense that there's an appetite to come in and buy. Yeah. There's this. You do this for long enough, Sean, as you both you know, you can just hear things in people's voices. I think there's still more concern out there on the street. But another tidy list I think I want to share with you guys. 3 Yahoo Finance reminders during this summer sell-off. First, this is not a panic. One of the first stories that I woke up to this morning, not on our site, was someone calling this a panic. I hate that word. I think it sparks more fear and concern out there in the markets. This is what markets do. They're trying to find the source of truth. This is price discovery in real time. This is not a panic. Number 2, this is not yet a washout, which is something we were just talking about, where all the bad news is priced in. I'm still hearing a lot of fear in the voice of markets out there. I'm not saying, at least the people that I've talked to, not saying, hey, I'm going all in on Apple here. I'm really buying this dip on Tesla, and I'm buying all this, really buying the dip on NVIDIA too as well. And then last but not least, NVIDIA's fundamentals have not changed. And Sean, I really loved your column on Sunday. I encourage everyone to check it out. It is blowing up on the Yahoo Finance charts this morning. It's still this tug of war. Blackwell chips, as you mentioned, but people, they seem to want to sell NVIDIA right now. I know you made the case that maybe based on the people you're talking to, people want to come in there and buy NVIDIA. Maybe that's the case, but I would just encourage everyone to remember the fundamentals have not changed on NVIDIA, even though you're seeing the stock price get absolutely creamed.
Yeah, and I think the question is what exactly is going to be that catalyst? And it's impossible. We've talked to strategist upon strategist who says it's impossible to time the market at any given point, especially given so much uncertainty right now. But at least the sources I was talking to within that piece were laying out the case as to why earnings, when we do see the results from NVIDIA, could be a catalyst for NVIDIA specifically and some of those chip plays. But again, you also see the type of action that you're seeing today, the selling, the downward movement. There's a lot of people that I think feel a little bit more comfortable, at least for now, staying on the
And that's why I'll just quickly mention, this is not Shauna Smith saying go out and buy that NVIDIA dip. This is your sources. So don't blame Shauna if this goes the other side. She's just reporting doing her work.
Yeah, all right. Buy a coffee, though. That's what we can recommend. Make a list, check it twice, and we'll keep having this conversation here on Yahoo Finance. Brian, thanks so much for joining us this morning. Well, we want to dig further into the sell-off with Ed Yardeni, who is the president of Yardeni Research. Ed, you've just heard the setup. You've seen the setup going into today's trading activity with some precipitous declines that were set to face at the opening cross. Want to get your estimation of what you think this is most attributed to and how you expect investors to react.
Yeah, well, everybody seems to attribute most of this sell-off to the news we had on Friday that was disappointing employment. But I really think the weather had a lot to do with the weakness in July's employment report. I think the sell-off here is to a large extent attributable to the unwind of the so-called carry trade. It's turning out that a lot of speculators went and borrowed in Japan at zero interest rates. They raised a lot of money in yen at zero interest rates and then converted the yen into dollars. So the yen weakened, the dollar strengthened, and they took that money and invested it in assets around the world, including the Magnificent Seven, Mexican assets, Brazilian assets, and some of them even went didn't go that far. They went into the Japanese stock market. And now with the central bank tightening while other central banks are easing, the yen suddenly had a big move to the upside, and that strength really led to a lot of margin calls of these speculative positions. And I think the proof of that is that it's a global sell-off, which suggests that a lot of money was raised in Japan at zero interest rates and used to speculate in other parts of the world. So I think that's all coming unglued, and I think it's a lot of margin calls, and I think it's going to happen pretty quick, and the unwind should be over by the end of the week.
And what do you think the extent of the unwind is going to look like?
Well, I think that, we're certainly seeing the impact of the unwind right now. But in many ways, this reminds me of 1987 when we had a sharp sell-off in the market. It mostly occurred in one day. This one may occur over a few days. But it did not lead to a recession. And I don't think what we're seeing here is attributable to an imminent recession or that we're in a recession now. I think this too shall pass, and I think the economy is going to prove to be surprisingly resilient. Now, of course, we may very well see that the Fed makes a comeback here, because the Fed may very well be concerned that this sell-off could start to have an impact on a negative wealth effect on the consumer. So they may very well do 50 basis points in September.
And should they do 50 basis points in September?
They might.
But do you think the case for that right now is strong enough?
The case for that is certainly strengthened, because I think one could argue that this could precipitate a problem in the credit markets. We are seeing that credit spreads are widening. So I think they don't need much more of an excuse to move forward with certainly a quarter point and very possibly 50 basis points.
Ed, it sounded like what you were referring to earlier was the event in Black Monday, and we all remember what's taken place since then. Of course, market-wide circuit breakers, limit up, limit down, new rules have come into effect to prevent situations like that. But when you look at the declines and the multi-day declines that we've seen like this, that put together a pattern or a longer period of time,
Yes,
where you've got red on the screen, does that, to you in this instance, mean that we could see a bursting of a AI bubble even
Yeah.
as we're tracking some of the de-risking that's taking place in the market?
Yeah, I think we've gone abruptly from risk on, which included speculation on AI, to risk off, where suddenly investors are saying, well, we can see the companies are spending a lot of money on AI, but we're not convinced that there's going to be much benefit anytime soon. And even some of the company managements expressed that view over the past couple of weeks. And so that's unnerved investors. A lot of things came together here all at one time. The surprisingly weak employment number on Friday, the carry trade unwinding, concerns that any day now there could be a widening of the war in the Middle East, uncertainty with regards to the political outcome on November. So I think this is also a seasonal phenomenon. Maybe it's an early September sell-off. It's started in August, could continue into September, but I think we'll find some pretty significant buying opportunities coming out of all of this. But right now, I think everybody feels like you jump in here, you're trying to catch a falling knife.
It seems like a lot of the fundamentals, though, haven't changed for companies.
No.
So where do you feel most confident buying in, even as we're tracking some of the precipitous dip right now?
Well, our position for the past couple of years and for a while has been that you want to overweight technology, financials, industrials, and energy. Obviously, they're all getting whacked, as are lots of other stocks in other sectors. But from a fundamental perspective, those still make sense to us as the place you want to overweight. So it doesn't feel like it right now. Right now, you want to be underweight them, but it's too late. It's too late to panic is sort of my attitude towards this sell-off.
Do you think the Fed leaving rates unchanged at the last meeting? I mean, hindsight is always 20/20, but was that a mistake?
Well, it's very easy to be critical of the Fed after the fact. I think given what they knew at that last meeting, it was very reasonable what was said, and that was to confirm expectations that there might be a rate cut in September. I think the knee-jerk reaction to the labor market report that it definitely means we're in a recession is incorrect. I think the economy is doing better, and I think the weather had a lot to do with. I'm blaming the weather for a lot of the weakness in July's employment report. So no, I don't think they made a mistake, and I don't think it's too late for them to act in a way that certainly stabilizes the situation here in the global financial markets. And I still don't think we're going to get a recession out of all this.
All right, Ed Yardeni, always great to speak with you. Thanks so much for hopping on with us, especially on a morning like today. President of Yardeni Research. We're going to stick with the market sell-off right now and take a look at what's happening globally, because we saw heavy selling during the Asia session, some of those losses carrying over here into Europe. For a closer look at what we're seeing on a global scale, Yahoo Finance Markets and data editor Jared Blickery. Hey, Jared.
Thank you, Shauna. And let's just take a trip around the world. We're seeing Nasdaq futures as well as Russell 2000 futures down 5% in the U.S. They are the leaders to the downside. Over in Europe, we have in London, we have the FTSE. That's down 3%. And you take a look at the year-to-date gains, it now just breached a significant support level. So I think a lot of these indexes are going to be testing their unchanged mark for the year fairly soon. You can see a similar dynamic out in Frankfurt with the DAX. That's approaching the unchanged line for year to date. But then where things really got started, and by the way, Ed Yardeni did a great job outlining the carry trade, defining that and how it's affecting our markets here. And you can see this playing out. In Tokyo, the Nikkei is down 12%. So now year to date, it is down 6%, had been in the green only Friday. And then you take a look at the max chart here. We're having the worst day since 1987, and it's hard to see. see. That was not the peak, by the way. The market would go on to reach a peak a couple years later, but I think that's instructive because it's possible that today is just a one-off. But you take a look at the leverage that has been built up in the system. This is all about the difference in interest rates between the U.S. and Japan. Japan just raised their rates only last week to 25 basis points, and we're talking about cutting. So Japan is kind of the canary in the coal mine. Japan is always the last to cut, and it's usually the first to, last to raise and the first to cut. And here's what we're seeing in the FX market. All this green means the yen is strengthening in a huge way against these currencies. A 1% move is really big in currencies because of the leverage. You take a look at 5% that we're seeing with the Mexican peso, that is just astronomical. And then you compare that with the year to date, we've seen some big moves there, but 5-year really tells you the trend. It's more been about yen weakening than strengthening, and today is just the beginning of that reversal. Guys?
All right, Jared, thanks so much for breaking that down for us. We want to stick with the selling action that we're seeing across the board and take a look at crypto because you've got Bitcoin plunging today. It did fall briefly below 50,000, now just slightly above that level, but breaching or falling below 50,000 for the first time that we have seen since February. When you take a look at Ethereum, that's also moving lower here this morning, off just about 24%, erasing its gains for 2024. And Brad, we bring this up because lots of talk about whether or not this should be viewed more as a place where people put their money when they do see a lot of volatility and risk play out in the markets. But when you take a look once again, which has been the case now going back for the last several months, is that it is moving in tandem with what we're seeing specifically within the Nasdaq and the type of pressure almost across the board. We are seeing this flight out of the crypto space, also crypto stocks taking a hit as well. But again, Bitcoin here falling just around that 50,000 level, critical level here to watch throughout today's trading day.
Yeah, absolutely. I mean, anytime you have a de-risking like we're seeing right now, crypto is one of the first assets that comes to mind here. And all of the crypto assets, the major and most traded, especially most valuable, at least by market cap, cryptos there on your screen, also impacting some of those equity market companies like Coinbase here, pre-market down by about 16%, Robinhood down 16%. So all of these things considered, Bitcoin is one of the assets that, even as we're seeing it cross back below 50,000 here, at least as of a few minutes ago, and a level that we hadn't seen, as you mentioned, since February. I think the larger thought going forward is, okay, for cryptocurrency, where are we likely to see even more of the same fervor to continue greenlighting other asset types that are continuing to touch this? You also have more trading desks that are getting allowance to finally push crypto assets to their clients too. And so if larger institutions are looking at that as a green light, there's still a lot of the fundamentals in place. It's just a de-risking of the riskiest assets here. And it's not just digital gold that's falling, it's also physical gold that is now still holding above 2,400, but off of the 2,500 level that we'd seen last week. Also switching gears here, a softer jobs report sparking fears of a U.S. recession, and Wall Street seems a little worried here. Big banks, they are now betting with near certainty that the Federal Reserve will announce its first rate cut at this cycle at its next policy meeting. Now, Citi is expecting a 50 basis point cut from the Fed in September and another one in November. Here to weigh in on her call is Veronica Clark. She's an economist at Citi. Veronica, always a pleasure to speak with you. Okay, so take us into the thesis here. I mean, we've heard for calls of 50 basis points. What do you think is really pushing more of your colleagues around the industry to really look at this as a watershed moment, perhaps, for the Fed to make such a stark move?
Yeah. I mean, I think we have seen the weakening in the labor market for some time now, and that was evident even before Friday's numbers. We had seen a more consistent increase in the unemployment rate, and Fed officials that were increasingly balancing their dual mandate, the risk that you might see some upside to inflation with the risk that you might see some upside to the unemployment rate. So even as of last Wednesday's Fed decision, those risks were really in balance, and Fed officials increasingly focusing on the labor market. But once we got Friday's data, that 2.2 percentage point increase in the unemployment rate at 4.3 now, softer payroll job growth, it does feel like this is a Fed that is going to feel like they're a bit behind the curve once they start cutting, and they're far from neutral at this point, so it makes sense to front load a bit of that and get rates lower pretty fast.
Veronica, talk to me about a little bit more, because there are plenty of people out there today saying that, hey, it's still too early to tell. This could be temporary cooling that we're seeing play out in the labor market. Why aren't you convinced of that?
Yeah, I mean, we've really seen signs that the labor market has been weakening for many months now. It's not just this one report, and that weakening has been accelerating. So I think that's the most concerning thing to us. It's really the trend that has been the correct signal, and not necessarily the level of the unemployment rate or the level of job growth. So we've seen things like the hiring rate coming down for many months now. It's at 10-year lows. You see that in the survey data. We'll see ISM services later this morning. Part-time employment rising, hours worked falling, all the early signs that businesses have been looking to cut labor costs. You don't see necessarily the big widespread layoffs yet, but that does feel like we're right on the brink of that. And initial jobless claims have been rising. So maybe that's some early signs that this thing could really accelerate.
Okay, with that in mind, I mean, do you think that we're going to be able to avoid a recession?
No, that's actually our base case, is that we are going into a recession. We very well might already be in it. The issue is recessions are usually defined a year or so after the fact. And what we're seeing now in especially the unemployment rate, it does look like what you would normally see in early stages of a recession. And the issue for the Fed is that we've had a year of pretty loose financial conditions. Equities have been rising. And now, of course, rates are rallying. We're pricing more easing from the Fed, but we're getting the stock market reaction. This is a tightening of financial conditions. Certainly, if the Fed isn't following through on what's priced at this point, that would be tightening financial conditions into a weakening labor market. And that, of course, can slow things down even more.
Veronica, we've seen traders starting to price in a little bit more aggressively, at least initially, the chances that we could see of an emergency cut. What do you think the likelihood of that is?
Yeah, I mean, never say never. It's not our base case. And I think the issue for the Fed is they don't want to look like they're panicking, they're stoking panic. But yeah, if you don't follow through on the amount that we're pricing, that would be tightening financial conditions. I think it's still probably unlikely. We just have limited economic data, at least. It's the jobs reports that the Fed's going to be most reactive to, and we'll get another one early September. So maybe not a whole lot of economic catalyst necessarily, but if you see the sell-off and risk assets continue, they're not going to be very comfortable with that.
Veronica Clark, Citi economist. Veronica, always a pleasure to grab some time with you. Thanks so much for joining us.
Thank you.
Certainly. Coming up, everyone, Tesla shares sinking as a broader sell-off sends Magnificent 7 stocks plunging. We've got some top movers for you on the other side of this short break. All right, we're just seconds away from the opening bell here to begin a new trading week, and there have been some precipitous drops coming into the start of today's opening bell, or today's trading session, rather. There you're taking a look at the Dow, the S&P 500, and the Nasdaq. The Nasdaq down 5% here pre-market. This is, of course, the Nasdaq 100 futures that we're tracking. We'll see exactly where the composite opens up, but the Dow futures and the S&P 500 futures both down roughly 3%, nearly 4% for the S&P 500 right now.
Yeah, also when you take a look at the 10-year, this move lower is also as of note here, and we also have the 10-year yield in comparison to the 2 years, also something we hadn't seen in quite some time. This is the opening bell that we're seeing play out right now on Wall Street. Again, when you take a look at where we are opening today, a massive sell-off underway. It started, well, really we started seeing weakness last week, but then carrying into what happened overnight over in Asia, into Europe, and now here in the U.S. As you take a look at where all three of the major averages are opening today's trading session. As we do shake out those opening trades, you do have the Dow, the S&P, and the Nasdaq all firmly in the red. You've got the Dow opening up, looks like just off about 600 basis points here. When you take a look at the heat map and some of the pressure that we are seeing across the board here, a lot of that being attributed to some of the losses that we're seeing in technology. You've got technology off nearly 3%, consumer discretionary, as it disappears from our board there for a second, off nearly 4% here. And taking a look inside the Nasdaq as well, some of those intraday moves that we are seeing as it struggles to pull up here, but we are seeing a lot of red on the screen here. This is looks like a little bit delayed here within our data, but if you guys can pull up some of the larger cap tech names, that's really where we are seeing a lot of that pressure play out, those losses being led by NVIDIA and Apple. Jared Blickery has a closer look at some of the selling action that we're seeing. Jared.
Yeah, let's queue up the Wi-Fi Interactive here. Just track the action and the early going. I'm going to start with the major indices. Here we have the Dow. That's down about 600 points. That's not the big news of the day. It's actually the Nasdaq 100, which should be opening at the worst levels since 2020. That would be a big down day for it. Not seeing action there. It looks like some of these quotes are delayed. So I do want to get to some of our heat map action. And let's just pull up our sectors. And there you can see that Nasdaq 100 getting those first big red flashes of the day. Apple down 10% there. And when we take a look at the sectors, you can see XLK down 6%. This is going to be one of the worst days in years. And we've had a few recent worst days in a long time here. Also seeing communication services down about 3.5%. That's the sector that has Alphabet as well as Meta. Only utilities and staples are in the green here, and those are two defensive sectors. So really a risk-off tone that we're seeing on the open. When I take a look at some of the leaders here, Bitcoin is the worst off. That's down about 20%. Then we're also seeing ARK. ARK is down 10%, and the Mag 7 themselves down 9%. Guys?
All right, Jay, thanks so much for breaking that down. Let's get to some of the trending movers that we're seeing, some of the biggest movers that we're seeing here at the open. A lot of those in the red here today, given the magnitude of the sell-off. Let's start with Tesla. You've got shares sinking this morning. You're looking at losses of just about 11%. Some of that sparked by those economic concerns that we're seeing playing out, really hitting across the board. The Nasdaq also sinking significantly here at the open. If you can pull that up, it's now off just over 6% here. So, Brad, what we are seeing, this rotation, we had started to see that play out of some of these larger cap tech names. But when you look at today's action, they're selling across the board. Small caps also not working in today's action. But with Tesla specifically, you're seeing this a continuation of the trade that we have seen now for quite some weeks, when we do see investors rotating out of some of the trades that had been working, at least most recently, given Tesla's recent run-up. And now we are seeing dramatic moves to the downside here, Tesla being one of the Mag 7 underperformers here today.
Yeah, one of the things, and it's both on the buyer side for a lot of people who are looking at the EV space and trying to figure out whether or not they need to purchase right now, especially if we're staring down as Citi was putting it, their base case for a recession, and then ultimately thinking about those large purchases and even financing large purchases, and of course the network for the electric vehicles right now. All those things considered, I think Tesla and the own pricing war that it had initiated coming back to bite itself for some of the margins that investors would like to see on a go-forward basis. We're still waiting for this ultimate kind of taxi network to come about. We're still waiting for some of the larger promises, especially in the unveiling of some of the new vehicles as well. And so in this interim period, especially combined with the larger market sell-off, Tesla is going to be one of the riskier assets, especially if Elon Musk has to accept the fact, or at least address, as it seems like he's becoming more prone to do so, that maybe the pricing war that it initiated is coming back to actually hit its company, unfortunately, in this near-term period of time. Another tech company that we're tracking here today, Warren Buffett's Berkshire Hathaway slashing its position in tech company Apple by nearly half in the second quarter. Company's stake now sitting at about $84 billion. That's down from $140 billion at the end of March. You're taking a look at Apple shares. They're down by about 10%. And this gets back to what we were talking about earlier, in that if you do see Berkshire Hathaway slash certain positions, or at least do some concerted or calculated profit taking right now, until you see them put that cash back to work, some of the bears are going to come into play and certainly have a more outsized voice in this market, where it's very easy for a bear to kind of have their voice very loudly known at this juncture.
Yeah, if you guys can put up the Apple intraday and what we're seeing here at the open, I just want to double check that this stat is still correct here, but we are seeing the significant, okay, we're having some trouble with our charts here. We are seeing the significant move lower in Apple. I believe it raised just about $300 billion from its market cap right at the open. If those losses that we had been seeing in earlier trading, at least during the pre-market, had held here throughout the open. So again, some key technicals to keep in mind when you talk about some of the pressure, just the extent of the selling that we are seeing play out right now, and what exactly that means here. Have been down just about 11%. So now that we're seeing losses of just under 10%, that's no longer holding there. But again, just putting this into context here, the sell-off, it's second only to NVIDIA in terms of that market cap destruction and what we are seeing play out within the broader tech sector. So again, Apple caught off with the broader weakness that we're seeing play out. Obviously, the fact that Buffett, Berkshire Hathaway here, trimming its stake pretty significantly, substantially within Apple is not helping matters at all. So again, you are seeing Apple one of the worst performers here this morning. All right, keep right here on Yahoo Finance. We've got much more of your market action ahead. Stay tuned. You're watching Morning Brief. A massive sell-off underway on Wall Street as we're just about 9 minutes into today's trading session. Let's take a look at the losses that you're seeing. You've got the Nasdaq off now just about 4.5%. So off the lows of the morning, but still that intense selling across the board. We can take a look inside those tech stocks. I want to also just highlight for you the Mag 7 names. Mag 7 index falling 9%. That's the most that we had seen since 2015. That's Bloomberg's Mag 7 index here. So to discuss the market sell-off and maybe what you should do right now with your portfolio, we want to bring in our next guest. It's Peter Chur. He's Academy Securities Head of Macro Strategy. Peter, it's good to see you here. So just first your reaction to what we're seeing play out in real time here at the open of today's trading day.
You know, it's playing out a lot quicker than I thought. I've been bearish, thinking we'd get a 10 to 15% move over the month of August. We're kind of in that 10% over the past couple of days. I think you want to remain very cautious here. I think there's a lot more selling pressure to come. When I look at things to me that are indicating that we've had what we call de-risking, people taking risk off the table, I'm not seeing it. You're still getting flows into things like TQQ, NVDL, which is a leveraged NVIDIA ETF. So I think there's more selling pressure to come.
Is this de-risking an AI bubble burst moment, Peter?
It's a little bit of everything, I think, right? You had all these trades kind of kept coming together. One thing I think we all talk about passive investing, right? And yet 50 cents of every dollar going into a large fund was pretty much going into, 10 different companies. So you had kind of this momentum factor building up. I think you've seen an explosion of option selling strategies, right? Whether it's through ETFs or every RIA recommending someone doing option selling. So you have this vol targeting type strategies. All those are unwinding. I think the trigger here was really recession fears put back on the table and this yen carry trade potentially unwinding. But I think that's going to, cause this waterfall of triggers, and that's going to keep pushing us lower into August.
Is that really the driver here, that yen trade, and really what we saw play out overseas, specifically within Asia, versus the weakness that we could be seeing here in the U.S.?
I think the combination is what's really causing the problem, right? If you had one or the other, I think we'd be fine. You see both of those coming together. And then to me, this market's always about leveraged players and people getting stopped out. And so you're seeing that in some of these vol strategies. I think you're seeing some of that in these leveraged ETFs. And then, I always say this kind of half jokingly, but everyone always says, hey, if X stock just got to here, I would buy more. And I think what they really mean is if X stock got to here, for no good reason, I would buy more. But there's always a good reason that we're down here. So I think you're going to see people question this. I think you're going to see a lot of people who wrote puts saying, I'd love to own a stock here, all of a sudden realize they don't have to cash to buy those. So I think this is just going to be kind of this, waterfall where one thing leads to another and pulls us down. I think we can get some strong rallies. We might well even get a 2 or 3% intraday rally today because liquidity is awful. But I think we are going to break the 200-day moving average on all the major indices.
Okay, so taking that into account, I guess the extent of the selling that we could see, if we do break below the 200-day moving averages, how much lower then could that potentially indicate or signal here in terms of how much weakness we could see play out within the market?
I think that's where it does get dangerous, right? Because we all know that 200-day moving average should be support. So when you break that, what happens? And my fear has been that so many people are kind of playing these technical levels. I think if we go through that, you could see a really accelerated Japan type move, right? Where you're getting down 10% in a day. So we're not there yet, but that to me is my fear, is that we'll bounce off that 200-day moving average as support a little bit. But if we break it, not to say all hell breaks loose, but yes, I think it could get ugly pretty quickly.
And so with that in mind, are there areas where, because when you see sharp declines like this, a lot of investors, to your point, they start to sharpen their pencils and try to figure out, okay, where are there going to be buying opportunities off of this, and what the setup for making that a viable buying opportunity looks like? What are kind of the pillars to that from your perspective here?
One I'll take a look at, say, on your fixed income portfolio, right? I think everyone should manage their equity portfolio different than their fixed income. We've been highly recommending duration, owning municipal bonds. You've had this great run. I like closed-end funds there. Start taking some profits, right? Start freeing up some cash. You've had some really nice returns in those investment-grade bonds, high yield. Free up that cash so you can put it to work in equities if and when the time is right. I think what I like on equities right now, I would buy energy. That's come off a little bit. If we have a geopolitical event anywhere in the world, I think that's going to really help the commodity industry and the energy companies in particular. Yes, it would be bad for the global economy, but there will be bottlenecks. So I like owning XLE. I like owning OIH. That's kind of where I want to put some money. And I've sold a bunch of my FXI and KWeb, my Chinese stocks. You start looking at them today, they're outperforming a little bit. And China's starting to show signs of turning it around. China's trying to sell their brands globally. So I would start nibbling on KWEB and FXI in China before I'd be touching or adding to any of the US stocks right now, other than the energy space.
Interesting potential trades there. Peter Chair, always great to have you. Thanks so much for hopping on with us here. Academy Securities Head of Macro Strategy. Thanks, Peter.
Thanks for having me.
Coming up, we've got much more of your market action ahead. Again, a massive sell-off underway. If we can pull up the 3 board here and take a look at where the major averages are just about 15 minutes into the trading day. You're seeing that intense selling across the board. You've got the Nasdaq off nearly 5%. You've got the S&P just above 5,100 and the Dow off just over 1,100 points. We'll be right back.
NVIDIA and Apple, 2 of the names sending the Nasdaq further into turmoil as the tech sell-off spreads across Wall Street. Here to weigh in on the tech rout is Gil Luria, who is the senior software analyst over at D.A. Davidson. Gil, thanks so much for taking some time here on the day where there's a lot of urgency just after the opening bell here. I mean, some of the names in your coverage are crossing below their 200-day moving averages here. You know, just walk us through the mindset that investors should have on a day like this.
So here's what's happening. There's traders selling because they're covering their yen carry trade. There's computer algorithmic trading that's selling because those traders sold. And then there's index fund computers that are selling because those two sold. What's not happening is somebody didn't wake up this morning and say, Apple, Amazon, and Microsoft are worth 5% less than they were on Friday. That's not happening. And so that's what's important to remember right now, is that fundamental-based investors really haven't changed their mind about the world since Friday. Things are the same, the prospects are the same, and they're very good for these large technology companies. They're going to continue to do well for a variety of reasons. That has not changed this morning.
So, Gil, should investors be viewing this, the dramatic moves that we're seeing lower in a name like Apple and a name like NVIDIA, should they be using this then as a buying opportunity?
2 different questions. I'd put Apple, Amazon, Microsoft, Google, Meta in one group. Again, companies that will do well. I don't think anybody's changing their estimates materially for the outlook for these companies for the next 3 to 5 years. With NVIDIA, the story is a little bit different for a variety of reasons, one of which is that some problematic stories came up over the weekend. One is that it's becoming increasingly clear from various reports that NVIDIA chips are, the most advanced NVIDIA chips are being sold into China. It's not NVIDIA selling there, so it's probably not an illegal issue, but their resellers are eventually making these chips appear in China, which they should not be. The other story that came up is that the Blackwell chips. There's an issue with the design. Delivers are going to be delayed. And the reason that's important is that it's not just a delay. NVIDIA has a window to sell to Microsoft, Amazon, Google, and Meta while those companies are hot and bothered about building out data centers as quickly as they can. That window will shut at some point, either next year or the year after that. If NVIDIA is missing out on some of those sales during that window, that does have an impact on NVIDIA's value.
And so in the near term, for investors that have perhaps overweighted their portfolio on AI themes, and NVIDIA being one of the poster children of that, along with some of the other names you just mentioned, should they be taking profits here, and what should they be watching for the larger cycle, the buy cycle, given how NVIDIA has leaned into and just said, hey, the demand is strong, so we're able to continue selling at this point? If there were some type of pivot in that, what does that equate to people's portfolios who've leaned into that theme?
So what I would say is there's companies that are going to benefit significantly from AI over the next few years where that value is not reflected in their stock price. First and foremost, Apple and Amazon. A year from today, most generative AI is going to be done on an Apple device, mostly on an iPhone. That's something that hasn't even started to happen yet. It will drive an iPhone upgrade cycle, and Apple's growth will accelerate from here. That puts them in a very unique position to focus on. For Amazon, Amazon Web Services has accelerated for the last couple of quarters because they're now catching up to Microsoft Azure in terms of AI capabilities. Companies will continue to buy that and increasingly buy it from Amazon because Amazon Web Services is the largest provider. Those things are still true. Will the overbuilding of AI data centers continue at this rate? That's a different question. But if it doesn't, that's good news for Microsoft, who's been overspending on CapEx. It's not bad news. They'll continue to get the business from AI in the long term. But if they stop overbuilding, overspending, their margins will actually be able to expand from here as opposed to contract, which is what they're guiding to. What that means for NVIDIA, again, their window is finite. And if there's less chips sold in that window, that's not good for them.
So Gil, real quick, as we wrap this up, we only have about 30 seconds here, but I guess your takeaway from the selling that we have seen and kind of this reversal in terms of some of the narrative and sentiment, especially surrounding big tech, do you see this pressure then overall, is it likely to be short-lived then on these stocks, or what's your read-through on that?
Well, that's very hard to predict on a day-to-day basis because, again, it's not factors that have anything to do with these companies that are guiding stocks lower. Reversing the yen trade has nothing to do with these companies. Concerns about geopolitical risk has nothing to do with these companies. So that's very hard to predict what's going to happen on a day-to-day basis. But again, these are very important businesses that have very solid prospects and good visibility into realizing their 3 to 5 year prospect. That hasn't changed this morning.
All right, we're going to be waiting for that next earnings report for NVIDIA to see if it could be some sort of backstop if the markets are continuing to decline into late August here. Gil, we appreciate the time. Gil Luria, who is the D.A. Davidson Senior Software Analyst. Thanks so much.
Thank you.
Coming up, everyone, some big banks are calling for more aggressive rate cuts this year. We'll be exploring the new forecasts right after the break. Stick with us. Several banks are taking a closer look at their Fed rate cut decisions. JP Morgan, Citi, Goldman Sachs, and more are adding or increasing the size or calling for earlier rate cuts this year. They're doing all of that in some cases. To discuss, we have Yahoo Finance's very own Josh Schaefer, who's been looking across this. Josh, what do we know about these?
Yeah, Brad, so more economists are coming out and saying they expect the Fed to cut more this year and perhaps cut deeper in September than initially expected. This, of course, comes after that July jobs report that had a surprise uptick in the unemployment rate, unemployment moving from 4.1% to 4.3%, triggering the so-called SOM rule, your recession indicator triggers, and overall just sort of fueling this feeling that had been happening coming into that report that perhaps it was time for the Fed to start cutting. Now people feel like the Fed is, quote, offsides. That's kind of the broad takeaway here from these economists. And I'll cite Michael Feroli over at JP Morgan. How far offsides is the Fed with that restrictive policy rate that you're looking at on your screen right now? He estimates about 100 basis points. So he's saying the Fed needs to move quickly to get that rate down 100 basis points, a 50 basis point cut in September, a 50 basis point cut in November to get rates back to a level that is a little bit less restrictive to keep this economy on foot. On that note, I should include that, of course, we have been talking a little bit more about recession coming from these economists. That has been part of this story here. But one thing I wanted to note, Goldman Sachs raising their risk of recession from 15% to 25%. That is not that large of an increase, and I think that's important to highlight here. Goldman noting in that they still continue to see recession risk as, quote, limited. And so, yes, they're saying that risks have risen, but when you just looked at that chart, they're not saying that risks are rather elevated. And I think that's an important takeaway to get from the economy right now. Risks are elevated to the downside. Maybe we should have been expecting some aspects more of a hard landing than we were, but not a lot of economists are coming out right now and saying, we now expect a recession in 3 to 6 months. That is not what these calls are. They think the Fed has time to act, and if the Fed does act, then the economy can still potentially get that soft landing.
We will see. All right, Josh Schaefer, great stuff. Thanks so much. Keep right here on Yahoo Finance. We've got much more ahead. Let's take a look at where things stand right now, just about a half an hour into the trading day. We're going to get some breaking econ data out at the top of the hour, but I want to take a look at where we are for the major averages, because the sell-off is really the top story that is playing out, obviously, right now on the street. You've got the Dow still off well over 1,000 points. You've got the S&P off just over 3%. The Nasdaq off its lows of the session, still off just around 4%. We're going to have more on the sell-off that's underway. Talk a little bit more about some adjustments that you should be making to your portfolio next. That's coming up on Catalysts. It's just after 10 a.m. here in New York City. I'm Shauna Smith alongside Brad Smith. And let's dive into the catalyst moving markets today.
Yeah, that's right. We're about 30 minutes into the trading day. Stocks continuing their sell-off here. The Dow falling over 1,000 points. S&P 500 down about 3%, 2.7% right now, 30 minutes into trade. And the Nasdaq Composite, that's down by about 3.4% right now. So we're off of the session lows, but still deep declines here. Trading platforms, Schwab, Fidelity, Vanguard, and Robinhood all down amid the volatility according to the down detector. So that's the service for all of those.
And the Magnificent Seven leading the tech-heavy Nasdaq sharp declines here. The Bloomberg Magnificent Seven index falling to its lowest level that we've seen since, or falling, the biggest drop that we have seen since 2015. Now, Nvidia, the biggest laggard, that's off just around 8%. We're also seeing some heavy losses from Apple and Tesla. Both of those stocks off just about 5%.
That's right. And also, ISM services data crossing the wires now. A weak print could further stoke recession fears that have pushed the VIX to the highest level in 4 years. We'll discuss how the spike in volatility is impacting retail traders later on in the hour as well here.
I want to get to some breaking news that we have out at the top of the hour, and that is what is on your screen right now. It's July U.S. services data, the ISM index, that ticking higher, at least from what was expected, coming in at 51.4. That was above what the forecasts had been expecting here. Business activity also rising during the month to 54.5. You got new orders also moving to the upside. Employment rising to 51.1. That was versus 46.1. You also have inventory changes. That rose actually to the upside. Prices paid also moving to the upside here. That was up to 57 flat versus 56.3. So again, when you take a look at July U.S. ISM services rising 51.4, that's coming in just above what the street had been expecting.
Yeah, the reading in July actually marking the 5th time that the composite index has been in expansion territory in 2024. Remember, before April, the services sector that had grown for 15 straight months following a services PMI reading of 49%. That was back in December of 2022. The last contraction, they note, before that was in May of 2020. 45.4% was the reading there. And so ultimately, we do have a quote here as well on the prices index that registered 57% in July. That was a 0.7 percentage point increase from June's reading of 56.3%. But 10 industries reporting growth in July as the services PMI has expanded in 17 of the last 19 months. This dates back to January of 2023.
All right, let's take a look at the sell-off that we're seeing play out right now in the street, because we do have markets still selling off this morning, although I do want to point out that we're well off the lows of the session. So here you have the S&P pairing some of those earlier declines. You now have the Nasdaq off just about 3%. You've got the S&P 500 now back above that 5,200 level. We saw the decline in equities. We saw the drop in Treasury yields. I also want to take a look at what we're seeing play out with the VIX, because we saw the VIX spike here amid more volatility entering the market. So what does this all signal about where the equity markets are headed? For that, we want to bring in Keith Lerner. He's the co-chief investment officer and chief market strategist at Truist. Keith, it's good to see you. So just give me your first thoughts on what you're seeing. We are well off the lows of the session, but still, we're seeing pretty intense pressure across the board.
Yeah, great to be with you. I wish we had more green on the board. It's been an ugly Monday after an ugly Friday. So here, big picture for us is before this sell-off, our view is when you have these strong first halves, you tend to see a pullback in the second half around the average 9%. It could be higher or lower. So around that today. I do feel like on a short-term basis, things it's starting to feel a little bit panicky. You mentioned the VIX, one of the highest spikes ever. I'm not here to call a low, right? It's hard to say when the low will be there, but I will say, historically, when you've seen the VIX move up by more than 15 points, and it's only happened about 4 or 5 times, when you look out a year out, you've been up every time. Now, Sean, one period that's interesting that I looked at was the 2018 period, where it was Fed related, but it was the other way. The people were concerned about the Fed moving the economy moving too hot. You did have a spike in the VIX. You made a lower low, and then you actually chopped around, but you did rebound. And I think that's a good template for what we're going to see going forward.
Keith, there are a lot of investors out there that look at a dip like this over the past several sessions here in aggregate and trying to figure out, okay, where does this present buying opportunity? Where are you looking across your own kind of investment landscape and portfolio landscape and saying, okay, here's what we've been waiting for to buy further into?
Yeah, well, at this point, we've been thinking we were going in a choppy period. I want to see after today if our indicators get to the extremes. Like as of Friday, we were telling our clients like the technology sector had not moved to an extreme as of yet, even after they oversold. So we're going to be looking closely at that sector's at the 200-day moving average today. The S&P, our best estimate is that the downside from here is probably limited to about 4 to 5%. So, I mean, if you have a longer term horizon, I think just more generally being in the overall market, I don't know that, again, being aggressive here, I think we might have a little bit further to go, but dipping your toe in if you had some cash on the sidelines. And I do think one area that we'll be focused on is tech. Again, is it the low today? It's premature to say that. But I think the risk reward is actually improving as you move back and you're taking off some of that complacency from the market. And the market had been pretty complacent into this number.
Keith, what do you think is going to be the catalyst for that reversal that maybe we could see once we are going to see some of that momentum return here to the market?
Yeah, well, you know, to be fair, I actually think we're going to be in an extended period of choppier waters because what tends to happen after you have a quick move down in the market and a volatility spike, that tells you that market participants were off sides. So then what tends to happen is you have a cluster of strong up days, strong down days, because there's a battle between fear and greed. And as opposed to just going back to new highs, you tend to go back and forth, making it frustrated on both sides. I think you have to get kind of past through August. From the bullish side, you want to see that things like the initial jobless claims, like the services this morning that actually confirm that the economy isn't heading into recession, and you get closer to when the Fed would likely cut rates. I think the challenge today is that the Fed isn't meeting for another 6 weeks. Yes, they can cut intra-market or intra-meeting, I should say, but typically they don't want to set off, perception that there's panic there. So I do think that this is going to take some time, and patience will be a virtue until we, I think, get past this. The economy confirms itself, and it will probably be later in the fall before we actually make a lot of headway to the upside.
Do you think that the Fed should institute a 50 basis point cut? The probability is moving that direction, at least from what we've seen in the CME FedWatch data.
Yes, we do, and that's a base case now is that September you'll see a 50 basis point cut. If you think about it, for so long the Fed was so focused on one side of the mandate on inflation. Well, the PCE, their core preferred measure, is around 2.5%. So now they should be squarely focused on the other side of their mandate, which is employment and the economy, and that's obviously showing some cooling here recently. So we think they need to get on with it. We think by most measures, almost any metric, you are still restrictive. So I think it's important that they start moving in that direction. But again, we might be in a little bit of a waiting period for them to do so. And that just causes the market to have some jitteriness. But again, I mean, the good news is at least you're moving more towards an oversold and discounting some of the uncertainties, which weren't being discounted well, I'll say, a week ago.
Keith, where do you think that leaves the Fed then as you look ahead to the remainder of the year? So past the September meeting, when you look ahead to November, when you look ahead to December, I guess how aggressive do you see the Fed needing to get then at that point?
I think as a base case, we would say a total of 100 basis point cuts this year, maybe a 50 and then 2 quarters. But to be fair, I mean, we have, the employment report that we had on Friday that really got the market's attention, that gets revised 2-3 times. So, I mean, unfortunately, it will be data dependent, right? The 3-month trend for the employment, by the way, right now is about 170,000. That's just back to the pre-pandemic trend. So by itself, the trend is cooling, but it's not weak relative to history. So I think it's going to be obviously data dependent, but our base case is 100 basis point cut from here.
All right, Keith Lerner, Co-Chief Investment Officer and Chief Market Strategist at Truist. Thanks so much for hopping on with us this morning, Keith. Great to get your insight. Well, the S&P 500 down just about 2.5%, so off its earlier lows of the session. You've got the index had a major run up so far this year ahead of that volatility that we've seen. Even with today's drop, it's still up about 9%, even with the recent pullback. But our next guest seeing some near-term risk potentially here for the S&P 500. Here to talk about that and the key levels that he is seeing. I want to bring in our next guest. We have Ari Wald. He's the head of technical analysis at Oppenheimer. Ari, it's great to see you. So on a day like today, I got to ask you, what levels are you closely watching given the dramatic sell-off?
Well, answer that one is 5,100. That's just a retracement of the prior rise. You have the 200-day average around that as well. So going to be looking for signs of stabilization there. But, really for us, it's taking a step back and seeing the market down about 9 to 10%, off its peak, still above those long-term moving averages as well. So this would still qualify as a pullback in an uptrend. With that said, On top of that, you had a VIX reading this morning of 65. Amazing. If you look back at the last 35 years, that was only exceeded during the depths of the great financial crisis and the COVID lows. And again, that's with the market only down 10% off its peak. So that would suggest that a market low is likely to develop over the next week or two, if not the coming days. So right off the bat, we think it's too late to sell. We are looking to buy, those positions that we see as core positions that we think we can own through what should be some additional market volatility. But I think there are some potential underlying warnings that would suggest that we're later in this bull cycle than we originally thought.
All right, talk to me a little bit more about where you are seeing the opportunity to the extent that you can, and kind of how you're identifying those areas that are more attractive, just given all the uncertainty that still remains.
Sure. So, yeah, we would fall back to kind of our discipline, momentum investing, where we're seeing long-term relative strength. That's going to be U.S. over world, large over small, growth over value. So we still believe that we are in a tech-led and a growth-led secular bull market. Obviously, there's going to be ebbs and flows around that. But I think as you see these big spikes in the VIX and markets down sharply, I think a great opportunity to buy the Nasdaq 100 for the long term. And then conversely, we would be, less sure about small caps here, which had a great July. But as we think about the possibility of peak market breadth, small caps likely are going to be the first to peak. They usually peak ahead of large caps. And that's kind of been in conjunction with some of our thinking. One of our established viewpoints has been that the market should top by the time you get closer to that first Fed cut. We've looked back historically, and bull cycles that develop against tighter monetary policy usually top when the Fed starts to cut its policy rate. And that's especially true when they are reactionary cuts, which appears to be developing there. So again, tops are a process. They take time. It would suggest, meaningful more upside versus the high point that we saw in July might be capped there. But I think there is a rally here in the ensuing process.
So Ari, then do you think that if we were to get a Fed cut here in September, regardless of if it's 25, if it's 50, it's still going to be a sell the news type of event, it sounds like?
Generally, yeah, longer term. I mean, listen, I could see a scenario where the Fed cuts, the market rallies, just given how much the rubber band has been snapped, and there's going to be this feel-good story attached to it. And I think the case could be made that as a market positive. But, our kind of thinking that would be part of more of a topping process, just given it seems to be more of a reactionary cut. And we've looked at the numbers. If you look at specifically points through market history, when the yield curve is inverted and the last policy move by the Fed was a cut, you're typically in your worst bucket. You'll see negative returns over a forward 12-month basis there. Again, it's not an imminent sell signal, but I think it does speak to this more later cycle and later inning bull market that we're in.
Ari, real quick, before I let you go, how should investors overall just be looking at the selling pressure that we've seen starting Friday and then into today? Is this almost healthy to an extent here for the market at this point in the cycle?
On the surface, it is. If you look at the indexes, they're all coming back into their 200-day averages, and there's really no meaningful signs of distribution, or at least it's just emerging. The concerns really lie in the rate market, and we're seeing some subtle shifts in leadership. I think in terms of what has changed over the last week is you had a significant breakdown in interest rates. And we've always said, be careful what you wish for. By the time you get lower rates, it's going to be the market pricing in more imminent recession. And we've seen the leadership of the market change as well, looking at the high beta versus low volatility ratio, which is pretty much offense versus defense. We have seen a shift towards defensive stocks, which we haven't seen throughout this cycle. So, the first kind of pillars of strength are starting to crack here. And those are the warnings to be mindful of as we look ahead.
All right, Ari Wald, great to have you here. Oppenheimer's head of technical analysis. Thanks so much.
Thank you.
Coming up, we're going to have more on the sell-off with tech in turmoil. The sector under pressure as the stock market rout continues to accelerate, although we are off the lows of the session. Right now, you've got the S&P off just about 3%. You've got the Nasdaq off about 3.8%. The Dow also firmly in the red, off nearly 2.5%. That decline had been more than 1,100 points earlier in today's session, now off just around 950. We got more on that when we come back.
From Windows and Azure to Word and Xbox, Microsoft's products have made the company a household name and tech powerhouse. In 2023 alone, the company generated over $211 billion in revenue and currently boasts a market cap of more than $3 trillion, making it the wealthiest publicly traded company in the world. What led to that success? Beyond the Ticker takes a closer look at the company's biggest moments. Bill Gates and Paul Allen founded Microsoft in 1975 to develop software for the Altair 8800, an early personal computer. In 1980, Microsoft signed a contract with IBM to bundle Microsoft's operating system, an early version of its MS-DOS, with IBM computers. In 1985, Microsoft announced the first version of Windows, an operating system composed of a graphical user interface running on top of MS-DOS. A year later, on March 13, 1986, Microsoft kicked off its IPO, raising $61 million at $21 per share. On August 24, 1995, Microsoft launched Windows 95. The software would go on to be wildly popular among PC consumers and enterprise customers. In 2000, Steve Ballmer took the reins at Microsoft, succeeding Bill Gates as the company's second CEO. The next year, Microsoft jumped headlong into the gaming console wars with the debut of the first Xbox. In 2008, Microsoft dove into the cloud computing space with its Azure service. In 2014, Ballmer retired as Microsoft's CEO, turning over the position to Satya Nadella. In 2019, Microsoft's market cap crossed the $1 trillion mark for the first time. In 2023, Microsoft kicked off its push into generative AI with a $10 billion investment in ChatGPT developer OpenAI and the debut of a number of generative AI products, including its revamped Bing search engine and Copilot software. The company is now riding the AI hype train as far as it can, adding generative AI software to everything from Office to Windows and anything in between.
Let's take a look at some of today's big movers, and we got to start off with the selling that we are seeing in tech. We've also have Josh Schaefer, our markets reporter, here with me to break it all down. But Josh, let's take a look at what we're seeing on the screen, and that's Microsoft and Alphabet. Both of those names in the red, off the lows of the session. We're only about 50 minutes into the trading day, but you're looking at Microsoft now off just about 3%. Alphabet also seeing some losses here, and we're seeing some unwinding of the trades that had been working, right? So a lot of the weakness that we are seeing play out within the market, very broad-based, but really a lot of the bulk of that selling action coming from some of these Mag 7 names that had been working now for so long.
Yeah, it's a continuation of the trade that we've been tracking for several weeks now, right? When you take a look at what's led the market lower since basically mid-July, it's been big tech, right? So it's not surprising on a day like today to see big tech leading the way lower. I've talked to a couple strategists this morning that have essentially argued it might actually be a good thing that big tech is what's leading the market lower. When you look at the sectors on the day, the fact that you only see consumer discretionary and big tech lower than the S&P 500, you can pull a positive spin out of that, which is people keep wanting to sort of unwind their Mag 7 trade from those names you're looking at on your screen, but might actually be interested in putting money to work elsewhere. It's not a complete flight to safety panic move. It's more so, okay, let's reposition and get into something else that could work. I thought Kevin Gordon at Schwab made a great point about big tech earnings last week to me. He said it really was no different than the economic data story. It's just a story of expectations. And we had gotten to a point with a lot of these stocks trading near all-time highs that the expectations for them to keep beating earnings and raising revenue guidance and continuing to just go up, up, and up, at some point, you just can't meet those expectations. And so it's not to say that those earnings weren't good, because I think a lot of analysts we've talked to over the last week look at most of those companies' earnings and say, the fundamental story is in pretty good shape. It's the fundamental story isn't quite as great as the market might have hoped. And so you're seeing people just pull back their bets a little bit.
Yeah, exactly. We talked a lot about the lofty expectations heading into earnings season and how high the bar had been set for so many of those Mag 7 companies. And you're right, because when you take a look, at least for all the ones that have reported, except for NVIDIA so far, they have reported pretty solid. I mean, this is a broad stroke here, but I think the overall takeaway so far this earnings season has been they have been holding up. They have been showing impressive growth. But of course, the question is going forward, the momentum, or I guess to the extent maybe that some of that growth is going to slow, given those lofty expectations.
Right, and then you look specifically, we're talking big tech, and you look at what's down right now and what's down the most. NVIDIA's down the most. Why do you think NVIDIA's down the most? Because those expectations had gotten so lofty, right? And the stock was up 150% this year, more than that at one point. Tesla's down. Tesla had been ripping for the last 3 months. To see Tesla down 6%, a company where the fundamental story is in question and people are wondering about the earnings trajectory, it just adds up. And to see other stocks being weighed down by a lesser extent, I do think, again, you find a little bit of solace in sort of that market action.
All right, let's talk about one name it's been pretty volatile now for quite some time. We've got earnings coming up. It's a top trending ticker here in Yahoo Finance. That's Palantir shares also being dragged lower this morning in the wake of this sell-off, being caught up in some of that broad-based pressure that we had just been talking about. Those shares off just about 7.5%. So of course the setup here into earnings, never great. But in terms of what expectations are, lofty expectations, whether or not we are going to see the company meet that. They have government sales could outperform their expectations after closing a $480 million U.S. Army deal. But again, when you take a look at this name, the volatility that's been surrounding Palantir over its last several quarters, I think many are questioning whether or not it is going to live up to some of those expectations as well.
Some pretty big gaps on the chart in Palantir if you look over the last year and even the 5-year, right, on earnings, and just massive moves because they're an AI trade, right? And so you've had big swings on earnings when they talk about how AI is going to help them, how they're going to monetize AI further, et cetera, et cetera. And so I think it's going to be an interesting time for them to report earnings, because we've been talking essentially, as we're talking about the market being down, is a little bit of a shift in market sentiment, right? Kind of that AI, if the AI trade isn't working for Microsoft, Alphabet, Meta, it's hard to see that it's going to start working for Palantir, but maybe they can produce earnings that do sort of shift that narrative, or they can say something on the call that can. It is definitely coming in a tough environment, but I think just in general, how the market reacts, whether it's an aggressive move to the downside, or perhaps maybe it's just that the stock doesn't fall that much. You know, there's a world where that's a win in today's market action after earnings. And so I think it will be interesting to see what kind of sentiment and want there is for Palantir shares after hours, given the fact that it is really one of the leading players in that AI trade. The Messi of AI, as our friend Dan Ives likes to call it.
Messi of AI, I actually forgot about that. But yeah, even when you take a look at the 5-day chart, you can see some of the pressure that Palantir has been under. It's off just about 15%, 3-month, just below the flat line. But then when you compare that to even the year-to-date gains, it's still up, Josh, to what you were saying before. I mean, still up just about 33%. And a lot of those wild swings that we see in the stock, a lot of that being attributed to AI and some of the promise of the future and what exactly AI could unlock here in terms of the fundamental story for Palantir. So we will see what happens after the bell today. All right, let's also take a look at crypto because that's selling off today. Bitcoin briefly falling below 50,000. We're now actually back above 53,000 here. The sell-off is also sending crypto-related stocks lower. You've got Coinbase, Robinhood, MicroStrategy, all firmly in the red today. And Josh, when you take a look at the risk-off trade, what has been happening, what has been playing out within the markets, also especially the correlation between many of these crypto-related stocks, or really just crypto more broadly, when you take a look at the moves with Bitcoin and compare that to the Nasdaq and some of the tech names, we've seen close correlation to that here over some time. So again, the risk-off trade, investors aren't jumping in to crypto, it doesn't seem like right now.
Our head of news, Miles Umland, wrote last week that Bitcoin was the tell before the sell-off started because it was the first thing to move last week. And if you were watching the market at all last night, it was once again the tell, right? I got a notification at some point last night that Ethereum was down 20%. And I sort of went onto my phone and was like, wait, what's going on? And then that's when you start kind of getting clued in because crypto is trading 24/7. It's interesting to see it fall a little bit more as futures started to open, as the market opened, and we shift towards sort of that narrative toward the exchanges as well. One interesting thing I just noticed with Coinbase, though, we're looking at it down about 8%. Those shares were down 18% at one point in pre-market trading, and as we started the show at 9 a.m. And I just think it's interesting to see if you really look at the one-day intraday chart, yes, it's down, but it's been climbing back up. And that's sort of what parts of the market have been doing throughout the day too. So you wonder how far in some of these areas investors feel like, okay, maybe we snapped a little bit too far the other way. And then sort of where do we settle in the middle is going to be an interesting one to watch, particularly with the crypto stuff.
Yeah, exactly. And that's important to point out too, because we've also seen that more broadly speaking as well with the major averages off the lows of the session. Also, many of those tech names that we've been talking about over the last several minutes, those are also off the lows. All right, Josh, thank you. Keep right here on Yahoo Finance. We got much more coming up. Again, we are closely tracking the slide that we are seeing across the major averages. As it stands right now, you do have the Dow back off more than 1,000 points. You've got the S&P off just over 3%. You also have the Nasdaq firmly in the red. More on that when we come back. We've got Treasury yields under some pressure here today. The 10-year yield is sinking. Now, investors questioning if the Fed took too long to start cutting rates, with the CME FedWatch tool showing over 90% of traders are now expecting a 50 basis point cut in September. For more, I want to bring in Brian Railing. He's the head of global fixed income strategy at Wells Fargo. Brian, it's great to see you here. So talk to me just more specifically, before we jump into the broader picture, just the movement that we have seen in yields and the 10 versus the 2 and some of those dramatic moves that we saw ahead of the open today. What's your reaction to some of that so far?
I mean, yeah, I saw some really dramatic moves. I think the 2-year got down, I think we're like 20 basis points higher than we were this morning. So some really dramatic moves. I mean, clearly bonds are kind of, your risk off asset class of choice. So, when there's a lot of fear in markets, you see really big moves in fixed income. And we're seeing that today. We're seeing things moderate a little bit here. Some of the kind of fearful trade at the market open has dissipated a bit. So things may be getting a little bit more rational, at least for the moment, in fixed income.
So, Brian, what does that tell us then? When you take a look at the 10-year yield, you have it right around 3.77. Is that a rate? Do you think it's going to stay below 4 given some of this uncertainty? Or what are you seeing what's ahead in sort of the range that we could likely see?
Yeah, I mean, there's still a lot of uncertainty, not just around the economic situation, but geopolitical events. The election now is much closer than perhaps it was a couple of weeks ago. So there's a lot of uncertainty in markets. I think as long as that uncertainty persists, we'll trade below 4. I would be really surprised if we saw the 10-year move below 3.5, though. I think we would need to see some really strong evidence that the economy here in the U.S. is weakening at a much faster pace, or something breaks. That's always the risk at times like these. Liquidity dries up. There's a problem somewhere that was not anticipated. Things break. So that's a risk out there. But absent that materializing, I think we'll trade between 3.5% and 4% here until some of the uncertainties that are on the horizon clear up.
Brian, there had been some talk, and it was even creeping into the markets ahead of Friday's jobs print, about whether or not the rally that we had seen in Treasuries, if it had been a little bit overextended or overdone. And then we've seen the moves of the last 48 hours all play out. I guess, what is your read on that? And do you think too much is being made over just this one print on the labor market?
That's a really good question. It is just one print, although, we've seen the trend now, slowly weakening, maybe weakening at a little bit faster pace here. So, I wouldn't be ready to throw in the towel and say a recession is at the doorstep or the labor market is completely rolling over. We need to see some more data before coming to that conclusion. But the trends, of course, are going in the wrong way. So, we just really need to get a little bit better read on that before kind of drawing too dire conclusions, I think.
And Brian, what's your base case? Because we have seen traders really start to reassess the need for rate cuts, clearly by the dramatic moves that we've seen play out, specifically in the bond market. What are your expectations over the next several months?
Yeah, that jobs report last week did change my expectations a little bit, looking for probably more rate cuts clearly than we had expected before. I don't think we're at a point where the Fed needs to come in and do a intra-meeting emergency rate cut. Now, we may get to that point. Something breaks, something deteriorates faster, but I don't think we're there today. In fact, I think such a move might signal to markets that what does the Fed see that we don't see? Maybe there's bigger problems afoot. So I'm not sure that would be a good move anyway. But I do think probably the odds are increasing that at September, instead of only going 25, they go 50. But we do get more prints between now and then, not just on the labor markets, which I think are most important right now, but also inflation, which of course is the other part of their dual mandate. So I don't think there's any need to rush to conclusions, but I do think we're trending probably towards a bigger initial rate cut there in September.
All right, Brian Railing, great to have your insight. Thanks so much for joining us here, head of global fixed income strategy at Wells Fargo. Thanks, Brian.
Great, thanks.
Oil prices also under some pressure here today amid the wider global sell-off. You've got crude now just below $73 a barrel. You've also got Brent trading to the downside amid fears surrounding a slowing U.S. and global economy. Yahoo Finance's Ines Frey has a closer look at the breakdown for us. Ines.
Yeah, Shauna, and we are seeing oil that is off the session lows because it had been down to around $72 per barrel, just a little bit above that. Right now, you are looking at crude down almost 1%. Brent crude is down 0.7%. Look, this is all part of the market sell-off, the large, broad market sell-off that we are seeing across all assets. We are seeing crude that is down on that weak economic data that has been coming out, trickling in from the U.S. You also had some softness when it comes to China. So the China softness had already spooked the markets last week and the week prior, so to speak. And then OPEC Plus is expected to continue on with its production cuts unwind, those involuntary unwinds in October. Now, OPEC did say that they could reverse that decision. And you've got analysts right now that are saying we're in oversold territory when it comes to oil right now. So they don't see OPEC Plus really going forward with those production cuts starting in October. And then on top of that, you've got the geopolitical tensions with a retaliation expected from Iran against Israel after that assassination of the Hamas leader in Tehran last week. So you can imagine that you would see oil that is actually up if you have those geopolitical tensions in the Middle East. But right now, we're still seeing pressure for crude, guys.
And Ines, when you take a look at some of the other trades that are happening within the commodity space, I also want to point out some of the losses that we're seeing in gold right now. It is off the lows, well off actually, the lows of the session right now. But break down what we're seeing there and maybe what this signals or the implications for what's ahead.
Yeah, so we are seeing a gold that's down more than 1%. Look, this is normally a safe haven, so you'd expect to see gold would be higher also if the US dollar is moving in the opposite direction. But this just goes to show you the level of panic that you're seeing in the markets, the fact that everything is really selling off, even that safe haven of gold. If I pull up a yearly chart of gold, you are still seeing gold futures that are up 8% year to date. And we have seen quite a lot of volatility when it comes to gold. But when you see gold going down with everything else, then you know that this is a broad market sell-off. Everything's getting dragged down.
All right, and that's what we're seeing right now today. All right, Ines, thanks so much. Well, coming up, we're tracking the sell-off here in stocks. Again, you've got the Dow off at just over 1,000 points. You've got the Nasdaq off about 3.5%. Some broad-based selling playing out within the market. Ines was just mentioning some of the pressure that we're seeing in gold. You've also got gold and silver minor stocks tumbling as the equity sell-off deepens across the board. We've got a closer look at those moves to the downside next.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Investors using trading platforms Schwab, Fidelity, Vanguard, and Robinhood all experiencing issues this morning. That's according to reports that are out. This comes as the massive sell-off in the markets has sparked volatility. Here for more on this, we want to bring in Joe Mazzola. He is the head of trading and derivative strategist at Charles Schwab. Joe, it's great to have you here. So I'm on Twitter, I'm on X right now. There certainly are a lot of complaints from customers not being able to log into their trading platforms. Can you give us a better sense of what's happening right now at Schwab?
Yeah, sure. I mean, some clients, they are experiencing intermittent issues on some of our platforms, but we are working to resolve the issue as quickly as possible. And as you mentioned, it doesn't appear to be unique to Schwab.
Joe, what are you seeing in terms of the retail buying activity? Because I think that's what a lot of people want to get a sense of right now, especially given the dramatic moves that we had seen play out over the last couple of trading days, and especially this morning. Are we seeing traders focus on the names that had been favored, like some of those big tech names so far this morning?
Yeah, so we can reference our Stacks report, which is our Schwab Trading Activity Index, and that will take us all the way through to the end of July, basically July 26th. And what we saw in that report, if you can remember, some of that deleveraging was already starting in July, where you saw movement out of some of the big tech names and saw a bounce in the Russell, and the spread between the performance on the Russell and the Nasdaq was fairly wide. I mean, the widest we'd seen in years. But what we saw from our community was a little bit different. We didn't see the retail clients deleveraging to the same extent that you saw with maybe some of the institutions. If anything, they were dip buying on some names like Broadcom and Nvidia, and then Chipotle. Those were our three biggest buys.
Joe, what do you attribute that to?
What do I attribute that to?
Yeah, just a change in behavior. I mean, give us a better sense of exactly then what retail traders are then pricing in.
Yeah, I think a lot of it started last week. I think that there was some weakness in the job data that spooked the markets, and it creates a bit of a cascading effect. There's three things that I would absolutely point to in terms of this market in general. I think there was a lot of kind of short volatility plays that I think are starting to unwind a little bit, and I think that has to do with some of the carry trade that we've talked about and we've heard about over the last couple of weeks. And then I think it also kind of points to the fact that you saw position stacking where people were long AI, long the tech play, and then long calls, and so there was a bit of a leverage that was kind of stacked into that. And when you see, like I said, when you see that deleveraging happen, it happens very quickly. And what it can do is it can exacerbate some of the moves like we saw this morning.
Joe, what's your assessment so far of second quarter earnings season? Because overall they have, even take a look at some of those larger cap tech names. The numbers have been strong. I think there's lots of questions just about guidance and exactly what that growth is going to look like going forward. Is that something that you think maybe some investors are missing, just given the downward movement that we've seen in so many of those names right after they reported?
Yeah, I mean, if you just look at going back to last Friday, at that point, you had about an 11% year-over-year growth in earnings for the S&P 500. Revenues were a little bit shorter or a little bit lower than expected. I think you had about a 58% beat there. So that's a little bit below the 3 to 5 year average. And that's where, there might be some concern. And I think that's probably what investors are looking at, is this idea of, do firms have pricing power now relative to a weakening consumer? Are they going to be able to continue to drive that revenue, continue to have those profit margins, or are they going to have to discount? And I think what we've seen through some of the consumer discretionary stocks is that the discounting is starting. And what could that mean for next quarter's earnings when you see those profit margins coming in?
All right, Joe Mazzola, we have to leave it there, head of trading and derivative strategist at Charles Schwab.
Thank you.
Thanks. Keep right here on Yahoo Finance. Once again, we are tracking the every movement that we're seeing play out within the selling that's happening right now on the street. You've got the Dow just around right off its lows of the session, still off just about 2.6%. You've got the Nasdaq off about 3.6%. Some of those larger cap tech names, the Mag 7 names, well off their lows of the session, but still firmly in the red. Some of those losses being led by Nvidia. That's still moving to the downside. One, that's broader weakness, but two, we also got the report out over the weekend about some delayed Blackwell chips. That's contributing to the losses there. And then Tesla and Apple also leading the declines of the Mag 7. We'll be right back.
From creating graphics cards for gaming to becoming one of the world's leading AI chip companies, it's safe to say NVIDIA is officially one of the tech giants. In 2023, the company generated nearly $27 billion in revenue, and its market cap is currently hovering at around $3 trillion. Let's take a closer look at what led to NVIDIA's boom with Beyond the Ticker, where we dive into the company's biggest moments. NVIDIA was founded on April 5, 1993 by Jensen Huang, Chris Malachowski, and Curtis Priam, with a vision to bring 3D graphics to the gaming industry. In 1997, NVIDIA launched its first hit product, the NV3. It would later go on to sell a whopping 1 million units in its first 4 months of availability. On January 22, 1999, NVIDIA went public via IPO at $12 per share. And in 2000, Microsoft chose NVIDIA to develop the graphics hardware for the first Xbox console. 5 years later, Microsoft's rival Sony chose NVIDIA's hardware to power the PlayStation 3. In 2010, NVIDIA became the graphics chip supplier for automaker Audi. And in 2015, the company launched its NVIDIA Drive chip for powering driver assistance technologies. In 2016, NVIDIA kicked off its AI efforts with the launch of the DGX-1. 2 years later, the company debuted NVIDIA RTX, the first GPU capable of real-time ray tracing. That same year, Google announced it was using NVIDIA's Tesla P4 graphics cards for its Google Cloud platform. In 2022, NVIDIA debuted its H100 graphics chip for AI, which still stands as one of the world's most powerful chips for artificial intelligence apps. On June 5th, 2024, NVIDIA eclipsed that $3 trillion mark, joining the ranks of mega companies Apple and Microsoft. The stock continues to surpass its all-time highs over the past month and is currently trading well over $1,000 per share. From a company of 3 engineers working on graphics cards to thousands of employees working on chips that will power the AI supercomputers of the future, NVIDIA remains at the top of the tech industry.
Let's take a look at some of today's big movers here that are trending on Yahoo Finance. Brad Smith, he's back with me before Will. So here are the three stocks to break down in 30 seconds. Tyson Foods, Lockheed Martin, and Kellanova. Let's kick it off with Tyson Foods. You've got shares moving to the upside, so bucking that broader market pressure that we're seeing almost across the board. You've got Tyson Foods up just about 2%. The company beating expectations for profit and revenue as sales of meat products rebound. Taking a look at what actually stood out within this report, chicken was a bright spot, something that I saw analysts calling out here earlier. And when you take a look at the fact that it had net sales rising 1.6% to just over $13 billion in the quarter, the company's sales fell in 2023 again, so regaining some of those momentum.
Yeah, pork, one of the other categories that was really strong, up by about 13%, and at least the price change, but on a volume change, only up by about 1.2%. Let's also talk about Lockheed Martin shares. They are lower, along with the broader market here. The stock initially popping this morning after an upgrade from an RBC analyst to buy from hold. They also raised their price target to $600 from $500. You're seeing shares lower right now by about 1.4%, though, amid the broader sell-off that we are seeing in markets. Anything that is aerospace and more leaning more defense has been catching a little bit more of a bid, but we'll see where Lockheed Martin is able to drum up even more of those contracts important for its business and some of the larger projects that it's working on.
Getting caught up in that broader sell-off today. All right, let's take a look at Kellanova because shares are soaring. You got multiple reports saying that Mars, the maker of Snickers and other popular candy, is in advanced talks to buy Kellanova in a deal that would value the company at about $30 billion. We did see shares in the pre-market spike, I believe it was just about 20%. We're now looking at gains of just about 13%. But again, this would be one of the biggest deals of the year. Now, this is a stock that has actually performed relatively well since the start of the year. It gained about 13% through the close of Friday, obviously doubling that today. But again, we will see how this all plays out. Kellanova declining to comment to Yahoo Finance.
Pop-Tarts could have a new home.
Could have a new home.
Yeah.
30 billion though. That's a surprising valuation.
I mean, look, Pop-Tarts are worth a lot at the end of the day. I used to get the s'mores
Pop-Tarts
ones
and
every
some of
day.
the other snacks. All right. Keep it right here. Our very own Brad Smith. He's got you for the next hour. It's wealth dedicated to all of your personal finance needs. He'll answer all your questions of what you need to know surrounding today's sell-off, what you should do with your money. He's got you next. I'll see you tomorrow.
Some happy stuff in the show, too. Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts is going to give you the resources, tools, tips, and the tricks that you need to grow your money. We got a big show, big story for you today. The big market sell-off. We are off of the session lows of this morning, but stocks are still down 90 minutes into the trading day. There you're taking a look at some of these declines on a percentage basis being led by the Nasdaq Composite, the Dow and the S&P 500 also in the red. The Dow's down by about 2.7%. The S&P 500 down by a little more than 3% right now. And in just a few minutes, we're also going to talk to a strategist about the moves that you should and should not consider making within your portfolio here. We've got a lot to dive into, but before we get to that, let's take a closer look at the markets. We've got Yahoo Finance Markets and Data Editor, Jared Blickery. Hey, Jared.
Hey there, a little bit of a downdraft today. Let's put up the Wi-Fi Interactive behind me. And I just want to point out the trouble started over in Asia. Tokyo down 12.4%. That is the worst day since 1987. Korea, which is heavily levered to the chip sector, that's down almost 9%. And then in Europe, you have stocks down about 2 to 3%. And then in the US, it gets a little bit worse again. Here we have the Russell 2000, worse off than the majors, actually down 4.5% today. If I put a year-to-date chart on, you can see it is now slightly negative for the year. So we had this huge surge, kind of a tease recently, to the highest in a couple years, and now we have sunk back below the levels that we started the year with. So pretty big reversal of fortune, and that pain trade, well, it was a pain trade, that rotation that we saw over the last few weeks. Now the Dow is the best off today, but it's still down 1,141 points. You can see it's only holding on to gains of 2% this year. Then we'll check out the Nasdaq as well. That's still up 7% on the year, but that is a lot smaller than it was on Friday. So let's take a look at what's going on in the VIX. This is a fear index, and what I'm going to show you now is that we hit 65. That is the highest level since the pandemic, the height of the pandemic, way back in March of 2020. This is a 5-day chart. Check out the 5-year chart. You can see that pandemic high for the VIX was a bit higher, but we are in worse shape, at least in terms of the VIX. There's more fear in the market than there was in all of the 2022 bear market. So I think that says something as well. Let's go through some of the heat maps and we can see exactly visually how bad the damage is. We have tech and consumer discretionary, both of those down more than 3.5%. Financials and communication services also down more than 3%. Least bad in the shop here is real estate. That's still off more than 1%. When you take a look at the Nasdaq 100, lots of red here, barely any green. AMD up 0.6%, but Meta down 4%. So is Apple, Microsoft down 3%, Nvidia down 7%. But a lot of these stocks are off their lows. I should point that out. Let me just show you a 2-day chart on Nvidia. Here is the low this morning. It was down 13-14% on the open, and it's a little bit less bad right now, but a lot of the metrics that we're getting, we're seeing some of the worst losses in various ways since 2020, and so that kind of just skips over the 2022 bear market. That's a little bit of a cause for concern. Guys?
All right, Jared, thanks so much for breaking that down and also teeing up this next portion of our show here where we're zeroing in on the Nasdaq Composite here, leading the losses today, trading off nearly 4%. The index officially in correction territory, and that market close on August 2nd is what put it there. So what does this all mean? Well, a market correction happens when an index, ETF, commodity, or cryptocurrency declines 10% from a recent peak. Now, it's widely accepted to wait until the market has closed for the day to declare a correction. Taking a look at the Nasdaq Composite, the highest close of late was on July 10th at just above $18,647. At market close this past Friday, the index dropped to just above 16,758. So when we run the math, that is just over a 10% decline, officially putting the index into correction, and today's losses exacerbating those declines. And to get out of the market correction, the Nasdaq would have to close higher by 10% from the market close, the low, actually, we should say. And if losses actually break above 20% and continue moving lower, that's largely considered the bear market. So this 10 to 20% range in declines is what's the correction territory. 20% or more in declines would be the bear market. And ultimately, from the low to exit correction territory, we would have to move higher by 10%. Sticking with the sell-off, we're once again looking at where stocks are trading. Nasdaq leading the losses, down over 3%. Recession fears continue to push a global stock sell-off. So to discuss how you should consider the sell-off within your own portfolio, we've got here in studio with us Chris Shipley. Chris is the Fort Washington Investment Advisors Co-Chief Investment Officer. Chris, great to have you here with us in studio today.
Great to be here.
When you look across what we're seeing on the screen right now and people just tracking the ticker at home, hard to find any spots or any green arrows at this point in time. What are you telling investors and some of your clients that might be calling in today trying to figure out, okay, should we be hitting the panic button or should we be looking for opportunities?
We definitely don't think it's time to panic. I think when you look at the overall setup for the market, I do think that there was a certain vulnerability to the market at the levels that we were trading at. We were really pricing in an outcome that included both durable economic growth and lower inflation, providing the opportunity for the Fed to cut rates. What we're looking at now is a little bit more economic weakness than the market was banking on. And when looking at it through the lens of bad news is good news, which I think the market was looking at for some time, now you've had an accumulation of enough bad news that bad news is starting to be bad news. And we really have to think about whether or not we are entering a more substantive economic slowdown. I think there's a lot of reasons still to be optimistic on avoiding recession, but right now the market is shooting first and asking questions later.
What is the portfolio positioning that people should be considering then for bad news actually starting to be bad news?
Well, I think some of it comes down to how much bad news do you expect to accumulate. And I think when we look at the overall state of the consumer, I think it's important to bifurcate the consumer between the two principal categories that we have, which is homeowners and renters. And the reality is the economic experience for homeowners has actually been pretty good over the last couple of years. When you look at the impact of inflation, it's been much less significant on homeowners as the shelter component of the inflation data that we see has been hovering around the Fed's target of 2% for over a year. And so when you look at things from a cash flow perspective, homeowners have actually been okay. And if you look at it from an asset perspective, home values reached new all-time highs in May, and we had equity markets that were at all-time highs not long ago. So from the perspective of the homeowner class within the United States, which has twice the median family income of renters, that means that at least 80% of consumer income is being earned by people who are actually having a fairly good economic experience for the last couple of years. So that should provide a reasonable underpinning to the overall economy and keep the U.S. economy out of recession as a base case. So with that in mind, I don't think that we need to worry about significantly repositioning for much harsher times.
I got one uncle texting me today saying if the market continues to do this, I might have to go back to work and find a job at a golf course or something like that. Of course, that'd be beneficial to him. He'd get free rounds. But at the end of the day, for people who are looking at a sell-off like this and trying to figure out how they can continue to maintain their wealth, how can you build wealth even when you're seeing precipitous declines like this?
Well, again, if you take a long-term view, and I think as a retail investor in particular, you always have to have your eye on the horizon and what am I positioned for in terms of meeting those long-term objectives. If you're like many institutional investors, and you've been underweight this AI trade, for example, if you look at the relative performance of institutional money managers this year, it's been fairly challenging, suggesting that they've been underweight that AI trade. Now you're seeing those names on sale. We saw that once before this year when NVIDIA sold off 20% in late March, early April. And of course, there was an opportunity there that did not present itself again until just now. And so I think when you look at some of these factors and you think about where am I positioned and where do I want to be positioned for the long term, when stocks are on sale, it's time to start taking a look.
When we think about some of the stocks that have driven, and we're showing it on screen right now with the Mag 7 trade, and how much that has really permeated throughout the mind of retail and institutional investors here, is the Fed pivot now, or at least the cutting cycle, is that the pin that could burst the generative AI thematic trade that we've seen really take on so much luster and fanfare?
I do think that, and if you go back to July 11th when we had the CPI print that really started that rotation, and you really got a sense as to where investor positioning was on, say, small caps or on value, and you saw those begin to run as the expectation was that the Fed would be cutting rates, I do think that you have to think about some of those exposures. And right now, the S&P is exceedingly concentrated in these large growth names. And so incrementally, it appears as though the S&P 500 is less of a broad representation of the U.S. economy as it once was. And so when you look at areas like small caps, which are under pressure right now as people worry about the U.S. economy, if there is a broadening of performance within equities, it does seem reasonable to think that value or small caps are going to start to take a little bit more notice on the part of investors and potentially broaden out this trade beyond just this dominant AI theme that we've seen for some time.
Where are we likely to see the most evidence of a broadening, even as we're looking at some of the declines today?
Well, it's interesting. If you look at valuation, so for the S&P 500, we were north of 21 times not long ago. Yet the S&P equal weighted, meaning the median company in the S&P was actually trading right on top of its 10-year average of around 17.5 times. Now, all stocks have cheapened since then. So there has been places that you can find value within the equity market if you've been looking for discounted names, because there's been plenty of them to buy. Now those names are starting to come into favor. The real question will be, if we do see a more consequential decline in economic activity, then maybe we see a shift back toward these growth names, which are more secular and less cyclical. And so value, small caps, they do tend to be more cyclically oriented. They tend to be more sensitive to economic outcomes, particularly in the US. And so we'll see how far this degradation in the economy goes. Our base case is that we do avoid recession. And so ultimately, we do think that as some of these stocks come up for sale, that it's probably worth broadening that portfolio a little bit.
Chris Shipley, who is the Fort Washington Investment Advisors Co-Chief Investment Officer. Thanks so much for taking the time here with us in the studio today. Important time. All eyes are on September's Fed meeting, everyone. Over 92% of traders, they're expecting a 50 basis point cut at that meeting, after weaker than expected economic data reignited recession fears. To discuss, Yahoo Finance's market domination co-host Josh Lipton is here with us in the studio. Hey, Josh.
All right, Brad. So investors now have new questions about the overall health of the U.S. economy following that weak July hiring report we got last week. That sent the stock market tumbling, and the pressure continues into today's trade. All three major averages deep in the red right now. Investors concerned, is the economy just cooling, or are we now facing the possibility of a more serious economic downturn? That debate has heated up about the Fed's role in all of this, of course, with the question being asked, did central bankers wait too long to lower interest rates? Yes, our Fed policymakers suggested they could cut in September, but some economists now think that the Fed should cut by a more aggressive half point rather than a quarter point. As of this morning, markets were pricing in a more than 90% chance that the Fed cuts by 50 basis points by the end of its September meeting. That is up from an 11% chance just the week prior, according to the CME Fed Watch tool. I checked in with Joe Brusuelas, chief economist at RSM. He says the case for a supersized point cut has now been bolstered by the market action we're seeing. If this continues, he says, and we get another flat reading in the CPI and or PCE, the case even for an inter-meeting supersized rate cut, he says, would be on the table. What does all this mean for consumers right now? The yield on the benchmark 10-year is back well below 4%, creating the conditions, Joe says, to support improved lending, home buying, and auto purchases. It also, we know, brings down the cost of purchasing durable goods, things like washing machines and dishwashers. And Joe points out, tends to drive down the cost of variable interest rates on credit cards. But of course, at the same time, we now have a lot of new questions front and center for consumers and investors. Does the stock market keep reeling? Does the labor market go from cooling to cold? The economist Claudia Sahm recently told Yahoo Finance she is, in her words, very concerned that we could tip into a recession, Brad.
All right, excellent breakdown and conversations with some of the people tracking this closest. Josh Lipton, appreciate it. Going to be tuning in for the market close here today as well in market domination. Everyone, coming up later on in today's show on Wealth, we're digging into the biggest mistakes Americans make with their 401ks and how you can avoid them. Plus, our personal finance reporter, Carrie Hannon, joins for a conversation about how to manage your retirement savings in a shaky market as the sell-off continues. Plus, it's the beginning of August, and some of you may be sending your kids to school soon. Some of you may even be going back to school yourself. We've got some tips for you on how to save money on your back-to-school shopping. We've got all that and much more when Wealth returns.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
You might be taking a look at your 401k today, feeling a little shocked, to say the least, as a major sell-off continues to ripple through global markets. To discuss how you should be allocating to your retirement account despite the recent market downturn, Cassandra Rupp, who is the CFP Cassandra Rupp, CFP, Vanguard Senior Wealth Advisor, is here. Cassandra, great to have you on the show. First and foremost, as people are thinking through just today's activity, they're trying to get the sense of what a certified financial planner would be thinking about this and doing even in this. What are the first things that people should be keeping in mind?
I think we can only control what we can control. We put a plan into place regardless of what the market was going to do, what those conditions were going to be. So my job as a financial planner is to keep my clients on track with those goals and make sure we continue to follow them. So we're going to do that regardless of what type of day the market is having.
So what are the biggest mistakes that people make with their 401ks during days like this?
Well, in general, I wouldn't say always in days like this, in any day. I mean, just not maximizing the savings into these types of plans, not taking advantage of an employer match. If we're getting into some of the market components, selling out of investments at the wrong time, not following that long-term plan. You want to take a step back and say, what are my goals? What are my time horizon? And what are my risk preferences months ago when you're setting up the account, and not revisit that on a down market day. You got to abide by that planning.
Okay, so with that in mind, we're taking a look at some of those tips here. How do you also pick the right retirement portfolio for yourself?
Sure. I think it's revisiting those points we just discussed. You know, what type of investment product achieves those long-term goals? What risk am I comfortable with? Using something that is at a relatively low cost that's not going to consume a lot of the total return. Just making sure, again, that you're staying focused on checking in on that account over time and reassessing where you currently stand and if that still matches with the portfolio.
Certainly. And so from what you typically are navigating through in that thought process and maximizing your savings over time, I mean, what is the time horizon that somebody should be keeping in mind while they're also looking to maximize their savings?
I think everyone's time horizon can be different. I mean, if we're speaking to, you know, some of this reporting in 401ks for retirement savings, depends on what stage of your career you're at. We're seeing an increase in participant deferral rates above 4% now. So we're seeing more and more individuals start to automatically save out of their paychecks into these types of plans. We're seeing employers continuing to match these. If we're looking at average deferral rates, including the employer match, we're getting in excess of 11%. We want investors to be focused on about a 12 to 15% savings rate based off of their income.
Are there any key differences that you're seeing in how different generations are preparing and saving for retirement? Because there are some who are closer to retirement and looking at an activity and a trading sell-off like we've seen over the past couple sessions. Sure. That are saying, okay, well, hold up now, because I had banked on things remaining less volatile than this.
Sure. I think the Vanguard way is that we were banking on volatility occurring at some point, right? We want to take a step back when I'm speaking with my clients and say, what is appropriate for your time horizon now? So I'm not treating somebody who's in their accumulation years, who has a much longer time to retirement, the same as somebody who's already close to retirement, 5 years out, and just going to be needing liquidity sooner. So we really want to be cognizant of that when we're setting up the portfolio, when you're making decisions on what investments to use, so that there's not a panic when we reach this point, because it will unfortunately be inevitable. We are going to see market turmoil. It's just when that is going to come.
All right. Thank you so much for taking the time here with us, Cassandra Rupp, who is the CFP, and really breaking down, Cassandra at Vanguard. Thank you so much for taking the time.
Thank you.
The global sell-off continues here, but if you're nearing retirement, what does the sell-off mean for you? To discuss what you should do with your retirement savings amidst the global sell-off, Yahoo Finance's very own Carrie Hannon is here. Hey, Carrie.
Hey, Brad, great to be with you. I know it's a crazy day out there for people who are looking at the stock market, but this is a time when you're a retirement saver to kind of take a breath, because we see this often. This is, volatility happens in the stock market. And so it's a time when, if you step back as we look at this stuff, if you're investing for retirement right now, and if even as you near retirement, what's happening is you're investing. If you're in an employer 401k plan, you're buying high, you're buying low. So it all evens out. Markets are down now, but you're still buying shares because you are constantly investing in the market. So when it's down, when it's up, you're buying at both times, evens it out. Secondly, many retirement account investors are invested in target mutual funds. So if you're in a target fund, it is automatically rebalancing your portfolio as the stock market shifts around, whether it's soared higher as it has in recent months till today or Friday. So, and as it drops, so it evens it out for you. You don't have to make these decisions. The target fund, just a quick reminder, is if you set a date when you plan to retire, and the fund gradually becomes more conservative from equities to bonds as you approach your retirement age. But Brad, people who are very near retirement, this is a time to really look at your portfolio and say, okay, maybe I do need to cut off a little bit from the equity, the stock portion, and put it in some cash investments, because you want to not worry about the volatility in the future. So, and high yield savings accounts are still, we're at 5% until we see an interest rate cut. So move some over so that you have a comfort zone to protect you those early years of retirement, and you don't worry so much about the volatility. Those are just some important things, but it's really about, staying the course and understanding if your portfolio changes by 7 to 10% of the asset allocation you want to have in terms of your balance and your risk tolerance, then it is time to make some adjustments.
So, Carrie, what should people who aren't retired or nearing retirement do?
Yeah, so I want to reiterate for everyone that, even when you're in retirement or very close to retirement, equity investment is still part of the program, because you have, you're looking forward, you're looking to the future. And as you know, you may have decades in retirement, so stocks are always going to be part of your portfolio. So don't get spooked by all of this. Just be cautious and make no rash moves, is what I always say. For younger investors and retirement savers, this is a great time to really, once again, focus on that long term. Don't get all caught up in the day to day. Think about if it makes you really nervous, then maybe you do want to shift to a more conservative portfolio. But the truth of the matter is equities are going to be your friend in the long run. That's what we've seen over time, and it still needs to be part of your plan. And the sort of the rough figure we give people is 110 minus your age is how much should be in equities. You can push that up a little higher. It depends on if you're willing to take on a little more risk. But really think about target funds as well. Again, for people who get squeamish about volatile markets, if you have a long way to go, that target fund will help keep you on track.
Carrie Hannon, thanks so much. Appreciate the breakdown here.
Thanks, Brad.
Everyone, we've got much more on wealth after the break. You're watching Yahoo Finance.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
We are 2 hours into the trading day. Let's take a look at where stocks are moving right now with a quick market check-in as we're taking a look at the Nasdaq 100 heat map that we've got for you. Obviously, a lot of red on the screen, and here's what I do want to point out in some of the specific movers that we are tracking. We've been keeping a close eye on some of the moving averages, those that have already crossed below the 200-day moving average as of Friday's close here. Names like Amazon that you're seeing here on the screen, adding on some more declines here on the day. Over the past 2 days right now, you're seeing that move by 11% to the downside. Here today, adding on 3% in a move lower here. We're also tracking names like Microsoft. Microsoft at this level right now, it's down by about 2.2% over the day. Past 2 days, down by about 4%. And I want to pull this back out to a 5-day period. You're seeing 6% in declines there. That's a name where it had already been below the 50-day moving average and was at risk of going into that 200 moving day or moving below the 200-day moving average. Here with today's activity, we'll see where things settle by the close here. But as of right now, off of the session lows, but still down by a little more than 2%. And then just lastly here, I want to take a look at Tesla. Of course, another key name in the automotive landscape and tech landscape to track. Over the past 5 days, down more than 13% here today, down 3%. That's another name that was in fray here of potentially or on the fringe of potentially crossing below its 200-day moving average. So that's tech for you in a roundup there. Also do want to take a look at some of the major sector activity that we're tracking here on the day, just before we get to our last item here, where you're seeing all 11 S&P 500 sectors in negative territory intraday here. The declines really being led by energy and technology. Technology down by about 2.7%. And then just lastly here, let's go to crypto, because we're seeing some precipitous declines there as well. Earlier today, we saw Bitcoin cross back below 50,000 for the first time since February. And now we're taking a look at it maintaining right now above 54,000. We'll see exactly if we're able to, for a market that doesn't close, maintain some of that level and potentially see a bounce off of that 50K level here. I'll give you a year-to-date chart and then we'll go back into the intraday. Year-to-date still holding on to gains of about 23%, but intraday, and here's where you did see that level, 50,000 essentially moved through here. That's 51,000 over there. So disregard the line and just pay attention to that red line that I put on there. That's what's more important. That was the 50,000, but ultimately now back above that 54,000 marker as we were mentioning. We'll continue to watch that as well as a lot of the other cryptos that are moving lower in concert. Ethereum or Ether, whatever call it in your hood, call it down by about 14% right now. Well, the Fed is expected to cut rates at its meeting in September, given the recent weakness in economic data and moderating inflation. But did you know that the FOMC can actually cut rates without having a meeting? Here to tell us how is Yahoo Finance Fed correspondent Jennifer Schonberger. Hey, Jennifer.
Good morning, Brad. That's right. And a weakening job market, a weaker than expected jobs report last Friday has many on Wall Street questioning whether the economy is weakening and whether the Federal Reserve has waited too long to cut rates. Last week, the Fed opted to hold rates steady, but set the stage for a rate cut in September. That's about 7 weeks away from right now, though, and given that length of time, that has some floating the idea of an inter-meeting cut. That is cutting rates between policy meetings. The Fed will cut rates between policy meetings if they're concerned the economy is headed for a sharp recession or an economic shock has hit that could plunge the economy into a recession. And there are several instances historically where the Fed has done just this. The last time the Fed lowered rates between meetings was March 2020, when the pandemic hit and shut down the economy, sparking one of the sharpest recessions on record, though it was also one of the shortest. Now, before the pandemic, the last time the Fed enacted an emergency rate cut was during the financial crisis in January of 2008. Before that, in the wake of the September 11th attacks, and before that, in January 2000, following the bursting of the dot-com bubble. As for now, could the Fed cut before the September policy meeting? Well, JP Morgan chief economist Michael Feroli says that, quote, there is a strong case to act before September, but that maybe Fed Chair Powell doesn't want to add more noise. On the flip side, bond portfolio manager Wilmer Stith of Wilmington Trust says the Fed won't do an intervening rate cut because they won't want to spook the markets. Though Feroli, for his part, along with many other economists, conjecture that the latest jobs report raises the chances that the central bank could cut rates in September by 50 basis points instead of a quarter point. Powell said last week before the jobs report on Friday that the Fed was not considering a 50 basis point rate cut, but that the Fed has not made any decisions yet. Wall Street as a whole now pricing in more aggressive cuts as we go through the fall. 50 basis points for both September and November, followed by a 25 basis point cut in December. Now, Brad, while this jobs report was disappointing, Chicago Fed President Austin Goolsbee told Bloomberg Television on Friday that the Fed's not going to overreact to one report, making the prospect of an intervening cut probably unlikely. Back to you.
All right, Jennifer, thanks so much for taking us through that. Appreciate it. Well, wealth is often lost when it's passed along to the next generation. According to a study by the Williams Group, 70% of wealthy families lose their fortune by the second generation and 90% lose it by the third generation. So, with about $84 trillion in assets changing hands to millennials and Gen Z in the next 20 years, what kinds of conversations should families be having about wealth? Joining us now on this, we've got Valerie Kalinsky, who is the Bank of America head of the Merrill Center for Family Wealth. Valerie, great to have you here on the show with us this morning. First, as families are thinking about where they sit within this $84 trillion that's going to be transferred to next generation, how should they be frameworking their discussions about making sure that they're building on that wealth that's been accumulated?
Absolutely. Good morning, Brad. In our experience within the Merrill Center for Family Wealth, we have the privilege of working with over 300 ultra high net worth families. And what we've seen, to the statistic that you shared, is while there's a lot of excitement over the success that they've built, there's often a tremendous amount of anxiety. And what we find is, in a world that is focused on creating strategies, making sure there are plans in place, all of those things are productive, what we find the number one thing that could be helpful to any individual, any family, is first and foremost, defining what is the purpose of their wealth. Is it preserving? Is it, as you mentioned, passing along to heirs or other generations? Is it philanthropy? Is it supporting entrepreneurship? We find that unless someone can first take a moment and pause and identify that, in absence of that, developing strategies becomes much, much more complex.
And so with that in mind, how families are talking about the wealth that they've accumulated right now can also set them up for being able to build upon that. But what are the key questions that they should be asking about what's important in how they've built up that wealth and where, that also needs to kind of come back into reconsideration because, that same tree that they were perhaps building the wealth upon before is not going to be the same one that they're going to be able to draw upon forever.
Absolutely. And I think what you're hitting with that comment is really this notion of how do you define and manage expectations? Our team just released a report that was the culmination of serving over 1,000 rising generation family members. And one of the first things that we found is that there is a tremendous amount of fear and also some sense of isolation of how do you articulate those questions, right? How do you determine what the expectations are? So one of the things that we really encourage both the wealth creator generations, but also rising generation members, is really to come at it from a sense of curiosity, certainly respecting the financial success that exists, and really to try to understand what does success look like 5, 10, 20 years from now? What are the assumptions that are being made, whether it's about an investment strategy or a philanthropic strategy? What are the assumptions that are being made, and what can the family do today and tomorrow to make sure to put them into fruition?
You know, given how Gen Z and millennials, how we've prioritized certain investment classes versus others and asset types versus others, how might that potentially change the type of investments that see a massive amount of inflow as well post great wealth transfer?
Absolutely. So individuals, and certainly we see this within, a single family, there could be different interests, whether it's to, support more, let's say, environmental or socially conscious investments or others. One of the key points that we found in working with families is really understanding something I call deciding how to decide. And what I mean by that is, what is the latitude for decision making? If you have one individual family member making that decision today, and the vision, for example, is to pass those decisions on to his or her two daughters, what are the decisions that can be made? What are the areas that they would be comfortable with, to your point, in terms of the type of investments, in terms of the risk tolerance, and also what are the implications as far as liquidity, as far as the plans that are based on those assets?
Valerie Galinsky, who is the Bank of America head of the Merrill Center for Family Wealth. Thanks so much for taking the time, Valerie.
Thank you. Pleasure to be with you.
Coming up, everyone, we're heading back to school. Get those backpacks ready. Families gearing up for another busy school year, and that means it might be time to spend on some new gear. We'll tell you how you can ball on a budget for your school supplies. That's next.
For more than 6 decades, the discount megastore Walmart has redefined retail. In 2023 alone, the company brought in more than $648 billion in revenue. Beyond the Ticker takes a deep dive into the company's biggest moments. Walmart was founded in 1962 by Sam Walton. Its first location was in Rogers, Arkansas. 5 years later, the Walton family owned 24 stores and had racked up $12.7 million in sales. On October 1st, 1970, Walmart went public via an IPO on the New York Stock Exchange. Shares opened at $16.50 per share. The company opened its first Sam's Club in 1983 in Oklahoma in a bid to compete with Costco's wholesale member-only model. In early 1988, founder Sam Walton stepped down as CEO, and David Glass was named his successor. That same year, the first Walmart Supercenter opened in Washington, Missouri, creating what it's currently known for, that mix of general merchandise and grocery. In 1996, Walmart opened its first location in China and surpassed $1 billion in sales for the year. Walmart.com launched in 2000, allowing U.S. customers to shop online as Amazon.com began to take off. To compete with Amazon, among other online retailers, Walmart introduced free 2-day shipping in 2017. During the pandemic, the retailer boomed as consumers sought out the COVID-19 vaccine and meant cheaper groceries as inflation picked up. In late March, Walmart stock reached a record closing high of $61.45 per share, and it only keeps growing from here, with more than 10,500 stores in 19 different countries.
Class is almost in session. Families nationwide are gearing up for the upcoming school year. A new CNET Money report shows that families are expected to spend an average of $662 on their back-to-school shopping this year. And for many Americans, it's not easy to afford those expenses. For more on where you can find the best deals and save big, we've got Daisha Milden, who is the money editor at CNET. Daisha, great to have you here on the show with us. So let's dive in. First, perhaps on what the most anticipated items are to be bought during this back-to-school shopping season.
Yeah, so there are plenty. As we think about right now, the most expensive thing that we are noticing is, of course, technology. So our tech editor actually found that the good laptops are running about $700 to $1,000, but there are still ways to save for that. So when you think about sales, we found that there are literally sales happening almost every other week, even looking in terms of refurbished products, even thinking about some of the coupons and wholesale clubs. So just because we're seeing that really high price tag doesn't mean you have to spend that.
Daisha, I grew up in the era where, we just had one family computer that everybody had to fight over access to. Are kids getting their own laptops these days?
There are some families that do opt for having their kids on laptops. However, when we really start looking at what's needed for back to school, you may find that you need more than one tablet or even more than one set of headphones, and that can add up really quickly.
Wow, that would have saved a lot of arguments between my sisters and I growing up. All that aside, though, as we're thinking about how to save big, how can people make sure they're smart shopping as they're getting ready to go back into the classroom?
Oh, yeah, a number of ways. So we're looking at a lot of sales. There are a couple of states that are gearing up for tax-free weekends. My state actually just wrapped that up. So we're seeing that that's one way that people can save. But the biggest way is, number one, price comparison, making sure whether you want to go to one store versus the other, seeing where you can get the best deal, and then price matching where possible. But those big deals, those big savings, those are happening now for uniforms and back-to-school supplies. So checking out those stores, looking into those deals, those are going to be the biggest ways to save. And if your state qualifies, of course, tax-free weekend can be on top of savings for that.
You got Costco in this list of ways to save on some of those high tech items and high ticket items as well here. Is there one retailer that you expect to win out this back to school season?
Ooh, it really depends. We really got to start looking at a number of things. So when we look at refurbished tech being the biggest one, it's really hard to tell whether it's new tech versus refurbished tech. There's no particular one retailer, but I will say if you're looking at, let's say, a MacBook, you might start at Apple, but you might end up looking at refurbished tech like Back Market. You might even see that Woot has sales going on until tomorrow. So even if you're looking at a major retailer, still look at some of those other places too.
Just lastly, while we have you here, and perhaps it's just because we're getting close to lunch and I'm hungry, but I'm going to ask it anyway. This also means it's a return to families, households having like quick bites, quick snacks that they can toss in the bag and make sure that they're set for whatever the day holds in education ahead for them. So are there ways to make sure that even the food purchases, in addition to the tech purchases that you're making, can help you save some money over time too?
Oh, yes, I'm a mom. I know all about that. Definitely shop that wholesale club. See if you can go ahead and get a membership. Split it with another family if you can. That can really help you split down the price of snacks. See if you can do some price comparison shopping there. But more importantly, breaking down that bulk, splitting that price, and you still have everything you need for your kids' bags.
All right, now I'm officially hungry. Daisha Milden, who is the CNET Money Editor. Thanks so much for taking the time with us.
Thank you for having me.
Certainly. Hey, we've got much more on wealth after the break, everyone. You're watching Yahoo Finance. Let's end the show where we began. Stocks selling off this morning, but just off of session lows about 2.5 hours into the trading day. Here with more on how investors should manage their portfolios amid the sell-off, let's bring in Brian Mulberry, who is the Zacks Investment Management Client Portfolio Manager. Good to see you, Brian, and thanks so much for hopping on with us. You know, just as we are kind of ending out the closing portion of the morning portion of the session here, a lot of investors going into lunchtime just trying to figure out, okay, where do they need to continue to pay attention to some of these declines, and perhaps where are there opportunities being presented? How are you evaluating this?
Yeah, we've been a big believer that the market's been a little bit overdue for a pullback like this. Obviously, it's not fun to go through something like this, and I think in today's market, you see this type of action that probably would have happened over the course of a week or two get consolidated into just one day. And so we've been really focusing on high quality balance sheets. We like those names that have multiple ways of generating revenue, low levels of debt, so good cash flow metrics, and decent or better than the market earnings growth is possible to achieve with a higher quality balance sheet. So you're not being dragged down by the higher cost of capital. We're in a still higher for longer interest rate cycle. I know the market is trying to rationalize that, and we're seeing earnings get repriced along those names. So if there are places out there where you can go in a little bit more defensive sectors, like perhaps a consumer staples, and you would want to own things that have those types of metrics. Walmart, for example, you want to own that probably more than you want to own Target. You want to own Coca-Cola more than you want to own Pepsi. Again, being concentrated on quality is how you're going to survive this particular sell down in the market. We do know that it will eventually moderate. We're seeing we're off the session lows at this point in time. And so there could be an opportunity to find better valuations now than there was a week or so ago.
I was running through some of the large and mega cap, I should say, stocks that have moved to or through some of their moving averages at core levels. One of those is one of the names that's on your radar in JP Morgan, which is below this 50-day moving average here. Take us into your thesis and your thinking there.
Yeah, JP Morgan is a great example. They just went through a big stress test on the federal level, passed with flying colors, had a really strong earnings season, and said things are actually getting better on the investment banking side. This actual revaluation could show us even more activity, which means more revenue for JP Morgan. This is definitely one of those buying opportunities for a really high quality company at this moment in time. So if you were needing to reposition assets and you know, I want to certainly point out the fact that we're going to end this day still positive for the year on most of these indexes. And that means a lot of these names could have an opportunity to get a better position, a bigger exposure to higher quality names than just buying momentum the way this market has been trading over the last couple of quarters.
Brian, is this the type of sell-off where we would see a divergence in tech names and reason cases, perhaps? And I say that because you've got some of these names that haven't seen a massive shift, at least in the fundamentals. And I'm thinking of a company that we've been talking about as well. In NVIDIA, it doesn't seem like there's been a massive shift in the fundamentals. But then you have names like Amazon that have crossed already below their 200-day moving average. You have a company in Microsoft that I believe might be teetering with it here during today's session. We'll see where things close out. So is there going to be this divergence between some of those core technology names that have really led the charge here over this last 12 months?
Yeah, I think so. And the dividing line is going to be, where are you actually monetizing AI? Because all of those names have been carried by this AI momentum, this wave of energy that has existed for these stocks. And so the dividing line is going to be, what is your business model? There's been an enormous amount of investment from all of those companies in this type of technology, but who's actually closing the loop and generating revenue from AI? And we can point to Microsoft at least engaging in a subscription service that allows you to access ChatGPT through your Microsoft suite of products. And that's a $30 a month subscription. We can now say, okay, how many subscriptions have you sold? How close are you to getting your investment back and being profitable? The rest of the AI investment that's been made out there still isn't being monetized. And the dividing line is going to be, who's actually going to start turning a profit and when? And that's what I think investors are starting to ask as we start to get to this point of repricing earnings. What's going to be a drag on your balance sheet versus what's going to add revenue? That's going to be a really important question going forward.
Brian Mulberry, who is the Zacks Investment Management Client Portfolio Manager. Brian, great to speak with you as always. Thanks for the time.
Thank you.
Everyone, that's it for Wealth. I'm Brad Smith. Thanks so much for watching. Hey, you need to stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time. They're going to count you down to the market close. We'll see exactly where things settle at the end of today's trading session. You don't want to miss it.